Partners International. For this evening, we will start with a new panel of discussions where the principal topic is the evolution of BEPS measures and lessons incurred from companies operating in Latin America. For this panel of discussion, we would like to welcome Francisco Arvalo, partnered at EFE Consulting Group. Francisco, welcome to join. Francisco has a degree in business and administration with a specialization in finance management. His preparation in transfer pricing includes studies by the Inter-American Center of Tax Administration, and currently he is one of the 35 experts accredited by the National Federation of Economists Association of Mexico as an expert in transfer pricing. Francisco has over 10 years of practice in this area. Before joining EFE, Francisco collaborated with different international firms in supervisory and regional management functions. He has advised different national multilateral groups in the structuring and documentation Our next panelist is Gaston Fiorentino, partner at AGTP Experts, founding partner of IGTP Expert SAS. His experience has focused on matters related to transfer pricing both nationally and internationally. He has more than 16 years of experience working in the offices of PricewaterhouseCoopers, Argentina, Mexico, Colombia, and Barcelona, Spain. EY Lawyers, Deloitte Asesores and Consultores Ltda, the latter office from which he retired as a senior manager. He is a postgraduate professor in the Master of Laws and with an emphasis in taxation and externado de Columbia University, a member of the ICDT and the IFA. Additionally, he has participated in TP Mastery Transfer Pricing, Deloitte Global Tax and Legal, Berlin, Germany. Thank you and welcome. For our next panelist, Damian Larco, you're welcome to join. Thank you. Partner at TP Advice. He's an economist with a minor in finance, holds a master in international taxation. Prior to founding the TP Advice, he worked for the PwC and Deloitte and Touch, leading the tax and transfer pricing division. Assists clients with TP compliance, planning, as well as audit and defense issues in a broad range of industries. He's a professor of finance and has participated as a speaker at numerous transfer pricing seminars in Ecuador, Argentina, Paraguay, and Bolivia. Thank you and welcome. And for the last panelist, we have Maria Regina Monteiro. You are welcome to join. Thank you very much. Partnered at Monteiro Diniz with 18 years of experience, 11 of which with EY, Maria Regina is the leader of the international tax practice, also acting in local tax compliance and advisory. Maria Regina is also the nominal partner of our associate law firm, Monteiro Diniz Advocacia, expert in financial services and insurance and in tax advisory on financial markets operation for both local and foreign investors. She is specialized in tax optimization projects, risk advisory, tax diagnostics, structured operations, and due diligence, tax advice for local and international operations, analysis and of legislations and case law trends, tax packages, and AS for ASC 740 and FIN 48, quantification of tax contingencies, including for tax amnesty and installment plans, tax controversy, preparation and review of tax return, and tax risk mapping. Thank you and welcome. We will remember the methodology that we are serving for this panel of discussion. Each of our panelists will have 10 minutes to prepare their presentation and introduce the topic that they will be presenting. And later we will have 25 minutes with an open Q&A. Thank you. And we will start with Francisco Arvalo, who is the partner at EF Consulting Group. Francisco, you have the floor.
Thank you very much. Can everybody hear me okay? Yes? All right, well, good morning to everybody. I hope everybody is drier and warmer. I have the pleasure of opening today's seminars. We've been asked to speak about the current state of the BEPS measures adoption in Latin America, in our countries. And we also brought some lessons from court cases that are related or indirectly related to transfer pricing in our countries. So I'm gonna try to stick to the 10-minute time. So if we can, I think I have the control. All right, so in Mexico, Mexico has been very diligent in adopting the BEPS measures since 2014 tax reform. This is a brief summary of the main actions of the BEPS action plan, and as you can see, practically all of them are implemented in the tax law as of right now. We had an important tax reform in 2014, 2020, and 2022, which I'm gonna go over in a few minutes. So I'm not gonna speak on every one of these actions because of the time, but I will mention some of them that are particularly important. So tax challenges arising from digitalization. Right now in Mexico, we have an income tax on digital services and digital good providers, which is not the common tax rate of 30% in Mexico, but we have a 2.1% for passenger land transportation services, 4% for lodging and hospitality services, and 1% for sale of goods and rendering of general services. These withholdings are considered as provisional payments to the tax payable, and they are required to be filed in an annual tax return. The way the tax authorities implemented these measures was to give 1 year to the multinational companies and every service and good provider on a digital platform to register in Mexico as a taxpayer. Looking back, most of the multinationals and service providers are registered as of right now in Mexico and have a legal presence in the country and have started presenting income tax returns for the services rendered within the country. Also, on VAT on digital services, we are currently withholding the VAT to the digital service providers if they are not legally present or registered in Mexico, and also if they are. What's important here is that the Mexican authorities considered a provision that allows them to disconnect the platforms from the internet in case they are not paying the VAT on the services rendered. So this, as you would imagine, was very effective in order to incentivize multinational service providers to actually register in Mexico and have an economic presence in the country. This disconnection clause caused a lot of controversy because, well, the conversation right now is about how does this affect free trade disputes and political relationship with Mexico and other countries. Also, it is important to mention that there was an increase of 600% on fiscalization in digital services. Neutralizing the effects of hybrid mismatch arrangements, we do have a UPR rule in Mexico that makes the payments to companies that are established abroad in countries that are taxed at an effective rate of 22.5% or less, which is 2/3 of the actual income tax rate in Mexico. But fortunately, there is a provision where if you have business activity and substance documentation, transfer pricing documentation, and you withhold the taxes applicable, then the payment can be deductible if all the documentation is on file. We also have a limitation on interest deductions introduced in 2020. This limitation basically contemplates that the net interest, that this is accruable less deductible interest, exceeding 30% of an adjusted tax profit, which is a formulary calculation in the law, and applies both to payments of interest to related parties and to third parties. This measure also only applies to companies that have and that exceed 20 million pesos in interest expenses. So a lot of companies in Mexico are not bound to this limitation. It is also important to mention that this new rule coexists with thin cap rules in Mexico, which are 2-to-1 ratio. We also have, since 2020, mandatory disclosure rules. So this was also a very controversial measure, but it is now in function. All taxpayers and advisors must disclose aggressive tax plannings, and well, the penalties are can be very big, as up to $100,000 approximately. Also, tax advisors could earn a penalty of up to $1 million in pesos. This is only required when the resulting tax benefit surpasses 100 million Mexican pesos. So all tax advisors and multinational companies are required to estimate the tax benefit that is going to arise from these tax plannings. And you will also have to prove that the economic benefit is greater than the tax benefit of this tax planning in order to be approved. In regards to the MLI, Mexico just ratified the MLI last year, on October. And regarding transfer pricing, this is the sort of a timeline of the transfer pricing and BEPS measures adoption in Mexico. In 2015, the three-tier documentation was introduced. It is important to notice that The final BEPS plan and guidelines were not even published by the OECD, but the Mexican government had already introduced them into the income tax law. 2016, we introduced the tax authorities introduced the DEMPI approach in the legislation and a focus on substance in regards to intercompany service payments. So you have to make a benefit test in order to prove that you are actually receiving a service in exchange for the intercompany payment that you are making to a related party. We also have mandatory disclosure of transfer pricing adjustments. So if you make a voluntary transfer pricing adjustment, you have to disclose it, and you have to document with a letter from your advisor or a letter from the company explaining the reason of the transfer pricing adjustment. We also have, in 2022, we had a tax reform that overhauled the whole transfer pricing legislation. And we now have to disclose the domestic transactions with related party that historically were not subject to any informative disclosure or any informative return. Also, the highlights from the 2020 TP reform are the inclusion of these domestic transactions in the informative return. We also have to use the financial information from the comparable companies must be the contemporary to the fiscal year that is being analyzed. So this presents a challenge because the informative disclosure must be filed on May 15th. And as you already are aware, on May 15th, most of the comparable companies have not published their final reports and their financials. So we are now in talks with the authority in order to determine a viable solution or workaround for this issue. We have to break down all the comparability adjustments within the transfer pricing report. And we have some changes in deadlines. This is important also. The new tax reform gives the tax authority the faculty to use information from other taxpayers in Mexico as comparables in audit procedures for transfer pricing. So we had this rule back in probably 2006, and it was eliminated because, as you already are aware, well, this puts the taxpayers in a disadvantaged position. But this rule is returning now to the income tax law, and well, we are still waiting to see how this is going to turn out. This information can only be used by the taxpayers in an audit procedure, and it's going to be disclosed to the taxpayer that it's under review as well. But it cannot be shared. An NDA has to be signed by the taxpayers, and they can only see it in physical meetings with the tax authority. There's also an increase in penalties for non-compliance of transfer pricing. And importantly, the maquiladoras companies, which are the toll manufacturing companies all over Mexico that have an intercompany service with a foreign related party, they have to comply only via a safe harbor, which can be more costly than a transfer pricing analysis or even an APA that was very popular back in 2014 and the previous years. Also, the interquartile range is mandatory. There is no use of complete ranges. And also the adjustments would be to the median, as yesterday was mentioning. Basically, this is the TP current compliance in Mexico. We have to file master files, local files, informative return. We have to safeguard the transfer pricing return, the transfer pricing report, mandatory disclosure of TP adjustments, and we also have some criteria, official criteria of the tax authority stating that you cannot voluntarily adjust a transfer price if the transfer price was originally already within the interquartile range. So you cannot make any adjustments, arbitrary adjustments, even if you're moving from the lower quartile to the upper quartile or the median in any transaction. Lessons from the court. I wanted to present a case regarding a royalty payment. It is not directly a transfer pricing adjustment, but it was very controversial because it entails a lot of economic substance, legal property, and economic property of intangibles. So the Mexican income tax law grants taxpayers the possibility of making deduction as long as they comply with the requirements. And one of those requirements is that this expense must be strictly indispensable for the purpose of the taxpayer's business activity. So we have Company which is a foreign related party. We have Company B, which is the Mexican taxpayer, who had selling and distributing of beers and spirits to third parties, and also made payments for the concepts of advertising and promotion, as well as marketing expenses to third parties, and was under a non-exclusive licensing agreement with the foreign related party as well. Basically, the tax authority argues that the payments to third parties regarding advertising, promotion, and marketing expenses were not strictly indispensable for the taxpayer's business activity because the taxpayer was already in a trademark licensing agreement with a related party abroad. This was, of course, refuted by the taxpayers, arguing that they are in fact part of a common licensing deal, and this is also behavior that you can observe within third-party license agreements. But and this case was brought to the Superior Federal Court of Administrative Justice, and this is basically the arguments from the tax authority and from the tax payer. Basically, one saying that it is necessary to spend in advertising and promotion, even though they have a royalty payment to a related party. The tax authority, argued against it, basically. The resolution on May 16, 2019, released its criteria on the deductibility of expenses for propaganda, advertising, and marketings made by companies under a non-exclusive trademark license agreement to market their products. Basically, the tribunal or the court basically defined what strictly indispensable is, and they say that it is expense directly related to the activity of the company. It is necessary to achieve the purposes of its activity or its development, and that if not incurred, its activities would be severely affected. So this is basically what the court stated as a definition of indispensable. What the tribunal did basically was to analyze the corporate purpose of the taxpayer and basically analyzing what the marketing, advertising, and propaganda expenses actually entailed. Just to not go over too much, the tribunal ended up taking the tax authority side and negating or denying the deduction of the advertising and promotion expenses paid to third parties. And what was notable, it was that in the court case, in the resolution, you can see the tax authority, the tax payer arguing that this transaction should be analyzed via the royalty payment, and the royalty payment may be subject to an adjustment, but rather than denying the whole deduction of expenses to third parties. The tax authority did not acknowledge any transfer pricing implications in this case, and actually did not want to go into a transfer pricing dispute. And this left a precedent of the tax authority's strategy, which is because they have limited resources in transfer pricing, and they have some challenges retaining personnel and being effective in transfer pricing disputes. They are instead taking a route of making these simple negations of tax deductions when there is a royalty payment. So right now, this is a common adjustment that is being made in Mexico. So should you have any clients that are celebrating royalty agreements with companies in Mexico, you should take note of these discussions that are being taking place in Mexico. Some considerations, some questions that persist is Would the expenses be deductible under an exclusive licensing agreement? Are these expenses generating value for the legal owner of the trademark? And is it synonym with not generating value for the licensee? And should the incurred expenses be deducted from the royalty-based calculation? Was this in reality a TP discussion about the DEMPI functions in regards to the royalty payment? These are questions that remain still unanswered by the tax authorities and that are being discussed amongst transfer pricing colleagues in Mexico. And that is my participation for today.
Thank you, Francisco. Francisco Arroyo, partner at EF Consulting Group. Right now, we want to welcome Evan Chipardo, partner at Epica Consulting.
Excellent. Good morning. I will try to, in a few minutes, try to give you a glance of what is the situation in Panama and the LATAM region, okay? Well, Panama is more than Panama Papers. That's the first thing to say, okay? That's the first thing I have to say. Remember, it's a small country. Actually, it's a small open economy. By population, the smallest country in the LATAM region. By area, is the third smallest country in the region. We are experimenting a quite reasonable outcome as macroeconomic data. It's not the same in microeconomic. I see that is the same thing in all around the world. But if we take into account we are a small open economy, service-driven. 75% of our economy is service. That's 9%, 9 to 10% is agriculture, manufacture accounts for 10%, 10, 12%. The rest is service. So we are a service-driven economy. And we are a hub for business in LATAM. That's our role in the international economy, right? In the transfer pricing perspective, this situation gives us a structure where there are mainly subsidiary and low-risk distribution. That is the structure that is very common to see if you are looking at the transfer pricing structures, yeah? And we have a very important banking industry for the region. So that is Panama. It's a small country, small open economy. We use the dollar as our currency. And our numbers, or these brief numbers, gives you a glance that we are in a fairly good situations given the LATAM region. So, and that is our role. We are a hub for business, okay? Now, the transfer pricing, the tax regime in Panama, as you know, it's a territorial tax regime. That means that only transactions, operations in Panama are subject to tax, okay? Any income from abroad, it's not a taxable income. And that is the main reasons, I think is my opinion, that we are considered a paradise, tax haven. For some, we are tax haven. For others, we are hell. Depends on what you are, if you have to pay or not. That's it, okay? So residency, it's only relevant for withholding tax. So as you see, if you operate in Panama, you are subject to tax regime. So that is very important to clarify, because many people think that you go to Panama and there's no tax. It's a tax heaven. It's a paradise. It's not like that, okay? That's something we, as Panamanian, I don't know how many times I have to repeat that, okay? but that is important. Okay, so in this context, transfer pricing was introduced in 2010, starting at 2012. So we are in an early stage of transfer pricing, and that is the same for the whole Central American countries. Right now, if from now on you can deduct that our situation is similar for the whole Central America. It's similar. Every country has its own issues, but it's similar situation. We just introduced 10 years ago transfer pricing. BEPS, the inclusive framework, was signed by Panama in 2016. In that year, we included in our local file the information about the multinational corporation that, as how can I? We have a local file requirement, but we don't have a master file requirement. Okay, but in 2016 there was a requirement to include information of the multinational group in the local file. So that will be like a master file, okay? And in 2018, the special tax regimes were included in the requirements for transfer pricing. That is maybe the biggest reform in transfer pricing in the last years, okay? And it began its requirement in 2019. What are special tax regimes? Are regimes that gives benefits, tax, migration, and labor benefits for international companies that set up business in Panama to service the group abroad. Those are the special tax regimes. They are not only locations, but you can operate in a special regime anywhere in the country, okay? So all these TP requirements are based in arm's length principle, follow OECD guidelines. We have the heritage of method. We prefer internal comparables. Tax authority are driven to try to assess all their information through internal comparables, but there's no thresholds, no APAs, no thin cap rules, and no published safe harbor. So that means we are in a very early stage of transfer pricing, okay? So we adapt some BEPS measures since 2016, but really the most important was in 2018 when the special regimes were included in the transfer pricing requirements. Okay, what are those requirements? Well, we have to inform the related transactions in the income tax statement. We have to file information about the transaction, the transfer pricing analysis, and comparables and adjustment. When we file the report, we need to have a transfer pricing study, what we call a local file. And in 2018, the country-by-country report was introduced. As I said at the beginning, our economy is a low risk distribution and subsidiary driven. So in Panama, not many companies have their headquarters in order to present where is the headquarters that is informing or filing the country-by-country report. So this is the result of implementing BEPS in Panama. this set of documentation requirements. So in these early stages of transfer pricing requirements, what are the main challenges for the tax authority? Selection of method. Why? Because many of the companies that have transfer pricing requirement in Panama are distributors, and many of them use the resale price, okay? But tax authority look for the bottom line and say, okay, you got a gross margin that is okay, it's inside your interquartile range, but your bottom line, you're losing. So they're always challenging costs, plus they're always challenging resale price method in order to analyze it by the net margin. So TNMMA will be it will put the taxpayers outside the interquartile range. So that is very, very common. And that has been done for big international companies. Pfizer, LG, Sony, all of those companies have distribution through Panama. And most of them present their study or their case through a resale price situation. And they've been all challenged. Why? Because the bottom line, they're losing. So there is an opportunity for the tax authority to challenge those transfer pricing analysis. The rejection of comparables. Being a small company, a small economy, and having a lot of distribution and subsidiaries, and the tax authority asking for internal comparables, there are not a lot of comparables in Panama, as you can imagine. In the region, there are not a lot of comparables. So they are always challenging comparables, you know. And as yesterday we were talking, it's not a black and white situation. So the gray is huge here for the tax authority to reject comparables, okay? The other one is challenge, very common, is transfer pricing adjustment. If the bottom line has losses, many of the adjustment bring our taxpayer to comply with the interquartile range. That is something that every time would be challenged by the tax authority in Panama. And as I said, this is the same situation for the whole Central America region. And requirements for special tax regime. It was confusing before 2018 if companies that operate in a special tax regime had to present or file transfer pricing requirements. That was a big confusion because the transfer pricing law says that the requirement is for those who have income, cost, or expenses that impact your tax base. But if in Panama, foreign income, it's not taxable income, then is that part of the requirement to present the filing or not? That was a big question that had 80% of our challenges are the no formal presentation of your filing. That's 80% of the challenges from the tax authority, okay? So these are the common challenges we face in Panama. Right? And that's my presentation.
Thank you, Evan. Evan Chipardo, partner at Epica Consulting. Thank you very much. We will now proceed with Gaston Fiorentino, partnered at IGTP Experts. You have the floor.
Okay, thank you. Well, first thank Pride Partner International Thanks for the organization. Friend, thank you for the event, and thank you for all the college, all the presentation that were very good. So
Sorry, Gaston.
no problem. Well, thank you for the rain also. And well, uh, first, I will talk about Colombia and transfer pricing in Colombia. And when in Colombia, we are part of the OECD. So all the OECD guidelines are applicable in Colombia. We also have an important interaction with the OECD, and the administration, the tax administration, is very efficient in what they are analyzing and what they are challenging to the tax contributor in Colombia. What? Well, no, it's not yet. No problem. What it's happening in Colombia is that what is happening in the region, in Mexico, or in your countries, is that they are challenging not only the formal aspect of the submission of a transfer pricing study, also the context and the condition of the transactions. So what they're trying to...
There you go.
Okay. Well, what they are trying to analyze is the substantial of the transaction, because what they need to know if is it an influence, but taking into account the conditions. So which are the transaction that we analyze, or the transfer pricing transaction that are analyzed in Colombia? We have a national custom and territory free trade zone in Colombia. So we have the first type of transaction is the national custom and territory with a related company located abroad. The other type of transaction is with free trade zone with a related party located abroad. And also we have local formal obligations in transfer pricing between the national custom and territory and the free trade zone. And in that case, the national custom and territory, the taxpayer that had the formal obligation of the submission of the transfer pricing documentation. And we also have the obligation of analysis of transaction with third party that are or related parties that are located in a tax haven, and we have a blacklist of company of territory of jurisdiction that are considered tax haven in Colombia. As I said, Colombia's TP rule are in accordance with OECD guidelines. So, and the tax authority have the support of the OECD, of the SIAT, and there is a special inspector, foreign tax inspector without border that they support the Colombian tax authority. So they not looking forward only the formal obligation. They looking forward for the condition of the transaction and the method that you are applying, and why you're selecting that method. So this is a more deep analysis that nowadays the tax authority are doing. No. Colombia started its formal obligation of transfer pricing rule in 2004. And from the beginning, they were in line with OECD guidelines. They have an important interaction, as I said, in the OECD, and that is why nowadays is part of the OECD, a part of a political position, and they understand that the OECD help and give support to the tax authority in tax issues. So they were always looking forward to be part. So nowadays we are part. And in line with that, what is happening nowadays, for example, it's all that we are talking about. Pillar 1 and Pillar 2 are applicable in Colombia in the last tax reform. And in regarding Pillar 1, we have a new tax obligation that if the foreign company have a significant economic presence in Colombia, Pillar 1 directly, you had to pay the 3% of the income of the company in Colombia, or if you are not going to be part of the Colombian tax contributor, the banks will do a withholding tax of 10%. So it's quite the same as Francisco explained in Mexico, because in some case, in most of the case, we are aligned also with what is happening in Mexico. So for us is what's happening in Mexico will happen in Colombia. Include, well, I will explain something that Francisco told us, and it's happening also in Colombia. Pillar 2, in the last term reform, we have effective tax rate of 15%, equal to a global minimum tax. It's the same. No, and the intention was that not shifting the base of taxable in Colombia to another jurisdiction. So they start with this new tax obligation. AMP and MAP, we are stated. They are stated in the local TP rules. Regarding APM, what we have is that we sign only one APM, APE, but the tax authority have the two different office. One is the office like the good policeman and the bad policeman. The good policeman is the international office, business office, in which you negotiate the APA, and the bad policeman is the one that will challenge you. And regarding commodities, we are in line with OECD recommendation. It's mandatory to use the CAP method. The agreement must be signed and must be submitted to the tax authority. If the analysis of the tax authority didn't, they will challenge the price that you use, or they don't like, or they don't consider that is the price. They will use the shipping date price for the analysis, and well, perhaps will be a different type of adjustment. Each case it had to be analyzed. Financial loans, not only the rate, the condition, it should be analyzed, and in that case, we have a think-up rule for intercompany transactions, and also if the conditions are not arm's length condition, it could be the recategorization of the transaction. That means that a dividend will shift to an interest will shift to a dividend and will be taxable. Restructuring expenses should be assumed by the parent company. There is a difference between reorganization and restructuring. Restructuring is when it came from the parent company that they want to change the business model. Reorganization is when the company it must be a reorganization because it's going to start year by year in a losing position. That is a difference. In the case of restructuring, the present value of the operating profit could be challenged by the tax authority. So it is in line with OECD Chapter 10, I think, yes. And intercompany services, well, in line with Chapter 7 of the OECD guidelines, benefit tests should or must be provide in the formal local file and analysis, and the substance is very important of these expenses. We have the same as in Mexico, not in court. I am at this moment being part of the case that the tax authority is challenging the royalty and the expenses of marketing and publicity of a tax and also well, what else? Intangible asset. Well, a dump analysis is recommended, and also the royalty is not deductible if the intangible asset is developed in Colombia. This is mandatory, is in the law. So if you're going to do this planning that shift the intangible to another jurisdiction, but the intangible was developed in Colombia, it will be research. It will be not deduction that type of expenses. Formal obligation. Colombia is the formal obligations are very strict, and what we had to take into account is the threshold for define which type of formal obligation we have. So I am on time, but well, quickly. At first, we had to identify if there is a transaction between a foreign company or a tax haven. Then we had to analyze the total asset and the total income of the company. Well, we have all the information in the presentation. I think that you will have it. So, for being quick in my presentation, if you have all the if all the thresholds are greater than the numbers explained, the company will have three type of formal obligation. The first one will be the informative tax return, TP return, a local file, and a master file. And if it is a big company, a big multinational located in Colombia, also a CBC report could be part of the formal obligation. And this year, during September, we will have the submission, the obligation of the submission of the TP informative return, local file, and in the case that you are part of a multinational or you are not above the threshold, you will have a notification via email. It's a simple email that you have to send to the tax authority, who is the company that submit the country by country report. Master file in December, and country by country report in December. Something important, why September we had to submit is a change that the firm requests to the tax authority, because as in Mexico, they want that the information is the last information of the same if it is possible, the same year of the tax obligation, 2022, 2022. If you are using 2022 for the comparables company, you need to submit this in September, because the database didn't inform that the financial statement of the comparable company of 2022. Well, and this is all my presentation.
Thank you, Gaston. Gaston Fiorentino, partner at IGTP Experts. Now we welcome Damian Larco, partner at TP Advice. You have the floor. Damian? Oh, there you go.
Let's put my presentation. First of all, thank you, PPI, for having me. Yesterday, we looked at transfer pricing from a European and North American perspective. Now, Latin American perspective is way different. And here I agree totally with Mr. Ferreira. You gave us yesterday a master class. Thank you. And one of the things you said is that you explained very well the challenges that tax authorities face in Latin American countries. And one of them is indeed the lack of experience of tax administration officials. So here I'm gonna show you a couple cases. I have acted in Ecuador as expert witness. I mean, I've given my professional opinion in court during the trial, and these cases are the following. But before that, we operate not only in Ecuador, we also operate in Paraguay and Bolivia. So in Paraguay, they started off transfer pricing regulations in 2021. So of course, there is no experience in court. And Bolivia, we were asked by a tax official, tax administration official, to check on the transfer pricing reports, thus confirming they have no experience in for that job. But in Ecuador is another scenario. Transfer pricing rules have been in force since 2005, and here are some of the cases I've acted, as I told you, as an expert witness. And this is one of the cases. We call it transfer pricing and tax havens. It's let me give you some background. It's about a company in Ecuador that it's a wheat milling company. So the product is wheat flour. So the main raw material for its process is, of course, wheat. And this wheat is imported from a tax haven, the Isle of Man, where the corporate income tax is 0%, and compared to Ecuadorian corporate income tax, which is 25% nominal rate, because in Ecuador we also have a 15% employee profit sharing, which is calculated over the accounting profit, and it's a mandatory tax which is paid to employees. And so if you add up that 15%, which is the income tax deductible, you have an effective rate of 36.25%. So if you look at this scenario, of course, tax administrations might think there is some tax-based erosion in Ecuador, and profit shifted from Ecuador to the Isle of Man. Of course, you get good savings. So what the IRS in Ecuador, they checked on the transfer pricing report, which was prepared by Deloitte, and the transfer pricing method selected was the TNMM, and they agree with the method selected by Deloitte. They could have used maybe the cup method, since it's a commodity, wheat is a commodity. They could have used this method, but they didn't. In Ecuador, we have the sixth method, this Argentinian method, but only 3 kind of commodities. This is bananas, minerals, and oil. So wheat is not one of them, and they didn't use that method. Besides, in that time, if they would have had, for instance, the country-by-country report, they would have seen that in the Isle of Man, the company in Isle of Man does not have any employees, no assets, and the profits were shifted to that country. But instead, they used the TNMM, and what they do, they rejected some comparables with low margins, of course. And the criteria they used is that these comparables were not wheat milling, but corn milling. So that's the criteria they use. Of course, you all know that when you use the TNMM, the comparability criteria is not on products, but on functions, assets, and risks. So that's they were not they were totally wrong there. And the other thing they did is this. I told you this 15% is employee profit sharing. We in Ecuador apply the IFRS. So IFRS 19. We classify this 15% as a part of the operating expenses. So ability adjustment, and so we consider that 15% as part of the tax, the income tax, as it was before IFRS. It was considered as part of the income tax since it's a coercive payment. So the IRS here considered that we should apply the IFRS. They not approve that comparability adjustment. So we demonstrate to the judge that the comparables were right, and that the comparability adjustment, of course, it should be done. Because the comparables were from foreign countries that they do not have this 15% employee profit sharing. We won this case. The court ruled in favor of the taxpayer, so we saved him $3 million, which was the adjustment. So this is one of the cases I've acted as an expert witness, and which shows that the tax administration officers, they lack the basic concepts of transfer pricing. So the second case I'm going to show you is about transfer pricing and comparability adjustments. I'm going to give you some background here as well. This is about a company in Ecuador that manufactures canned tuna. And here, of course, the main raw material is the tuna loins, which are imported from Panama, that according to Ecuadorian law, Panama is a tax haven. So these loins, the company in Panama sells the tuna loins. Here, the adjustment was in fiscal year 2016 dollars by the TNMM, which was accepted by the IRS. They accepted all the comparables. The only thing they did not accept was the comparability adjustments. But what happens in 2016 in Ecuador? If you might remember, we had an earthquake. We had a big earthquake on April 16th, 2016. There was a big earthquake, so we were comparing companies, this company that was terribly affected by the earthquake with foreign companies that did not have, they didn't have something like this earthquake. So the comparability adjustments were mandatory here, and IRS, they accepted the part of this comparability adjustment. What they did not accept was what they only accept what the claims adjuster said it should be claimed to the insurance company. Okay, but one of those amounts that they did not accept was an increased cost of raw material. They accepted the loss of gross profit, of course, but did not accept the increased cost of raw material. Let me explain a little bit this one. This company produces the three product lines, which is the canned tuna, loins, and pouch. In the loins line, which was affected by the earthquake, this loins line produces as well residues, which are loins flakes. And these loins flakes are used in the formula to produce canned tuna. the formula, according to the standard cost, is 75% of canned tuna, is 75% loins, and 25% loins lakes. But since the loins were, the production was stopped by the earthquake, they had to change the formula to continue producing canned tuna, which was demanded by Ecuadorians because of the earthquake. So they had to change the formula, and they changed 85% loins and 15% loins flakes. But the unit cost of loins is 3.5, and the loins flakes is 0.5 cents. So when they change this formula, there's an increased cost of raw material of $2 million. And this is what the IRS is not accepting, because they say, since the adjusters, they do not accept this amount of increased cost of raw material, we do not accept it as well. But it doesn't make any sense, because they proved that they changed this formula and this amount. So right now this case is undergoing judicial review. So I think we have a lot of probability to win this case. So, but I don't know what you think. You might tell me your comments. And lastly, about the evolution of BEPS in Ecuador, we have the digital economy. We have VAT on foreign supply digital services. About interest deductions, they are subject to, they're limited to a 20% of EBITDA. About harmful tax practices, Ecuador, the IRS has identified 88 jurisdictions as tax havens. Panama is one of them. About tax treaty abuse, since 2015, there's a limitation of benefits clause. About transfer pricing, we follow the OECD guidelines. So, 2017 and now 2022, they are according to BEPS. So we indirectly follow the BEPS. About the commodity, we have, actually, we have these rules for banana oil and minerals, and they're not according to BEPS. We're not, we do not submit master files, and we're not required to submit master files in Ecuador. And about disclosure rules, as in Mexico, we're requested to reveal aggressive tax planning schemes. And the CDCR, we are not required as well. So this is a brief presentation of BEPS measures in Ecuador. So this is my presentation. Thank you so much.
Yeah, thank you, Damian. Damian Larco, partner at TP Advice. No, don't worry. Yeah. Right now, we would like to present to introduce Maria Regina Monteiro. She's partner at Monteiro Diniz. Maria, you have the floor.
Thank you.
There you go.
Good morning. Thank you. Thank you, PPI, for this opportunity. Oh, thanks. So we are talking now about Brazil, the hot topic of the moment. So first, a brief overview of BEPS actions in Brazil. Well, as you may know, Brazil has applied to be an OECD member since January this year. But Brazil has been a cooperative country for many years now. Transfer pricing rules are enforced in Brazil since 1996. Our friend Marcia was there. That's an amazing experience. And well, in fact, in Brazil, we already have for many years BEPS Plan of Action, as it's called. And it aims to contributing to the fulfillment of Brazil's development as well. Avoid, of course, the loss of tax revenue and the fairness of taxation, which is a pillar. One important information for you is that since 2014, due to FATICA, The Brazilian government established their CAT, which is a specific tax return, where the taxpayers may, by their own action, declare assets that they have overseas. So the Brazilian government gave this opportunity to the taxpayers before they started to, of course, assessing. So in 2014, this was an important action from the Brazilian government. And a financeira is a tax return that financial institutions have to submit, informing regarding U.S. citizens the accounts that they have overseas and the accounts that they have in Brazil. Regarding BEPS actions, I mentioned all of the 15, and I highlighted in green the ones that are enforced in Brazil. In yellow, I'm not sure if you can see, but I think you can. In yellow, you have the ones that are being implemented. Of course, you know that Brazil is transitioning to the OECD model. I will explain in a separate slide. And the one in red, Action 12, was not implemented. It meant to be implemented. There was a normative ruling from the IRS, but it was then extinguished because the aim was that taxpayers would declare their own tax planning strategies, and this was regarded as unconstitutional, so it was not implemented. And the main one, of course, is the country-by-country reporting. Nowadays, the Brazilian companies declare under the tax return, the income tax return, a specific schedule with all the required information regarding the country-by-country report. But we have a specific situation in Brazil because the Brazilian companies not usually are the ones that consolidate the information. So I think we have from the main companies, maybe JBS, which is a very important food company with many, I think there are 47 companies in Brazil, and they are the head office, so they have to consolidate their information, but most of Brazilian companies are not the head office, they are subsidiaries. So basically they don't declare the country-by-country reporting. When the company is not the consolidating company, it only has to declare the TIN number and say which company is the consolidating company. So it's for many companies, the country-by-country reporting is very simple to be filled out. Well, prevention of tax treaty abuse is something that was already being implemented by the IRS even before BEPS. It's something that treaty shopping has always been something that the IRS was looking at. And limitation on interest deductions, we have thin cap rules in Brazil. So the deductibility of interest when the company has, when the head office, the parent company has a participation in the Brazilian company, you have certain limitation for interest. When it does not, you have other limitations, but that's something that was enforced already. And I think these are the main items for BEPS actions. The most recent one is Action 1. It has been very highlighted that the tax challenges arising from digitalization and harmful tax practices are not enforced in Brazil. And I think these are the mutual agreement procedure. Action 14 is something that was implemented recently as well. I brought here Brazil's BEPS OECD status. I extracted this directly from the OECD website. So now you can see in details what I highlighted in the previous slide. And well, I added an additional hot topic for you. I think you all are curious about the transitioning of Brazil into the OECD model. In December 2022, it was enacted the Provisional Measure 1152, where we transitioned to the OECD standard, and basically it introduces the profit split method and TNM, which are the methods that are not applicable in Brazil. But One very, very important thing is that a provisional measure is not a law. It has to be converted into a law within 120 days. Provisional measure to be voted within the two houses of the Congress in Brazil. And if it's not voted, then you have additional 60 days. So we are now looking at April, where it's the maximum timeline for the provisional measure to be converted into law. So that's why we are not effectively implementing the OECD standard. And as the provisional measure, it aims at something that is relevant and urgent. These are the two pillars for a provisional measure to be enacted, because it is enacted by the president. It does not come from the Congress. So of course the matter is urgent and relevant, but if it's not voted in and converted into law within 120 days, it loses its effects. When it's born, you have an automatic effect. That's why the IRS implemented the normative ruling 2132. So the IRS already positioned and established the ruling, because the provisional measure is in force, but it has to be converted into law until April. So that's why we are in this gray zone in Brazil. And those are my presentation. Those are the main topics, and I will be available if you have any questions. Thank you.
Thank you, Maria Regina Monteiro. She's partner at Monteiro Denise. Thank you very much for all the panelists. At this moment, we will open a Q&A session for 20-25 minutes. So it is open for questions, comments, or any final remarks that our panelists would like to address. So is there any question, comments that you would like to add?
Just a comment, very interesting panel. No, just to congratulate the speakers, very interesting panel, very interesting. And you see that five Latin American countries, different realities, different situation, and different stage. But you see, there, if you look for the 15 actions, for example, action 12, for me, is one of the most interesting, maybe most important action of the BEPS program. But going back to my comments yesterday, are we ready to implement action 12? So if you approve in your legislation the mandatory disclosure of information, you must be ready to answer or to analyze, let's say, it's better, the planning that will be presented by the taxpayers. So if you don't have the conditions to analyze, to evaluate, how could you implement Action 12? So this is why BEPS is a long process, because even if you would like to have this possibility to oblige the taxpayers to present you their schemes, if you are not ready to analyze, even will be worse. Because in this case, we will receive, if you don't manifest, it's supposed that you approve the mechanism. No? Very, very interesting panel. Thank you.
Yes. In Colombia, in this tax reform, or in the last one, they try to introduce Action 12, but it's, as I said, it's in non-constitutionally, because we have give the obligation of the advisor to explain to the tax authority the tax planning, and this is against the local law in the constitution in Colombia. But they try. Nowadays, today, in the OECD, I have a friend of the tax authority that she's analyzing different issues or tax or things that they're trying to implement in future tax reform. You know, in Latin America or in Colombia, each each year, or perhaps in 2 years, we will have another tax reform. So, and they will include OECD recommendations in this tax reform. So we are in line, but as you say, it's quite difficult to implement because of local rules, and not a question of that the tax authority don't want to, or the legislation don't want to apply that's rules. It's a question of what you can explain about a tax planning, when a tax planning is, as I said yesterday, nobody in this room want to pay tax. So why are you going to show how I'm not going to pay tax? It's a
Yeah, just to come in on okay, go ahead.
I would like to hear the opinion of the panelists about the Colombia case. So if I understood correctly, Colombia is taxing 3% over the digital activities done without a permanent establishment. So I think for me is maybe 3% is too high in an effective tax rate when you calculate on gross revenue, no? Maybe 1%, one could be good, but 3%, okay, fantastic. But if you compare this solution with the complexity of Pillar 1, I think Pillar 1 and B will be excellent for you guys, really, because it will be very difficult for companies and for us. But this is a simple solution. You pay 3% of your gross revenue in the country, and the company could pay. And maybe if we adopt this 1 or 2 or 3%, I don't know how much, it will be a simple solution than to what we are trying to achieve with Pillar 1. No, say, I don't know. I'd like to hear from you. What do you think?
Yes, what happened in Colombia is that they apply this new rule of the 3%, but it will start in 2024, and it will be in line of Pillar 1. If Pillar 1 is applied for all the world, they will eliminate it. Exactly.
Because in Kenya, the guys said this at OECD and many international forums. They are collecting, I don't know if 3 or 2%, but they say maybe with 2%, they are collecting much more than they suppose they will receive from Pillar 1 to Kenya. So, and they have to eliminate. So they sign in Pillar 1 and they will lose revenue. This is complicated for a developing country.
Yes.
This is why many African countries, they are trying to find another solution.
Yes, but the solution is because also they don't want to give tax base to another jurisdiction. That's why they put this new tax of and it will be the taxpayer will critical this new type of solution, but it's the way that they don't want to give more in a population country, a president like is Petro in Colombia. They don't want to give this tax base to another jurisdiction because they need it, because they want to expand the expenses of the state of the public expenses in Colombia. So it's a question of a trade-off between what they want and what they need.
From the taxpayer perspective, the unilateral measures, that they're more complex. They're different in each and every jurisdiction, and it effectively leads to double taxation. That's why the Pillar 1 is preferred option.
Yeah, that's right, because uncertainty is bad for business. That's it. And taxpayers are in business, and it's bad for business. It's maybe an opportunity for tax consultancy, but it's bad for business. I think that if we simplify, it's better for everyone. It will be better for everyone. And in the Panamanian case, for example, as I mentioned, the special tax regimes. They just introduced a 5% income tax because they were zero income tax. Yeah, and that took like a month to agree, because at the end it's good for business if we eliminate uncertainty. And pillar one, I think that is the main goal, to have a more standard situation for all the countries. But I don't see it happening in the short term, and it'll be I think from in our experience, the problem is like we've been 10 years in transfer pricing, and we've had 4 different teams at the tax authority, and each team has its own way of looking to the challenges in tax reform, and that makes it very hard to sometimes comply or to adapt to the tax authority view of compliance. And that is something that could be eliminated if we try to simplify all tax regarding transfer pricing and even income taxes. That is the way for a country like Panama, that is considered a tax haven, the way to go. I think that is the best way to go.
Yeah, in the case of Mexico, very similar to Colombia. I mean, we have a very similar political landscape going on right now in our country. So we do have a unilateral decision on the minimum income tax on digital services. And as well, the government has said that if Pillar 1 moves forward, they will roll back these measures. But also in my presentation, I showed that there was a 600% increase in tax yes, from the tax authorities. So unfortunately, in developing countries and in Latin America, taxation and politics are very tied together. And with the current political landscape in Latin America, I don't think there's not many things that are for sure. But Mexico has been very compliant with the OECD and has always been on the forefront of adopting the OECD recommendations. So I think we can expect this unilateral measure to roll back and go into the standard of the OECD in the few years coming on. Yes, Jimmy.
Yeah, I have a question. If it will be abolished, the 3%, will it then apply to all companies or just to the companies with? Yeah, sorry. If the 3% will be abolished due to the implementation of Pillar 1, will it then be abolished for all companies or just for the companies that meet the Pillar 1 threshold, which is 20 billion? So that's, they lose much more than they will be gaining already for the difference in the threshold.
Yeah, I mean, at the moment, I don't think that's very clear in Mexico as whether that rollback is going to be just for the ones that exceed the threshold. My guess, and this is just a guess, is that they are probably going to eliminate this 3% for the companies that do exceed the threshold and maintain the 3% for everybody else in Mexico, so they don't lose this flux of tax for the government expense that it's also very quickly expanding in Mexico. Of course, yes.
I have a question regarding Ecuador and regarding the case that you were speaking, the first case, I guess. You spoke about 2 adjustments, certain comparable adjustments that were not accepted. I agree with the position that you obtained favorable because certain comparable losses are really comparable to the tested parties. So this is not maybe a point to be challenged to my understanding. But what about the other adjustment? Yes, the one that you considered the 15% of benefits to employees, like a non-recurring or extraordinary maybe expense that was excluded for the TMN calculation. Don't you think that if this is like a regular, I guess that the payment is done directly to the employees, correct?
Yes.
Like stock options or something like that. So don't you think that if this payment is being made from the companies to the employees every year, this was converted like an operational expense. And in that sense, in the terms of, or from the side of the IRS of Ecuador, it should be really included, because we have certain taxes in Argentina, very particular taxes applicable only in Argentina, not so big as a 15%, but I guess that after certain year, 5 years of application, then you can consider it should be an operational expense. So at the end of the day, companies are paying that and consider that they should obtain profits above the 15% that they have to pay to the employees and above the 25% of income tax rate of Ecuador. So if you don't obtain a profit above the 40%, you will not be profitable, never. Yes. So I don't see so strange the position of the IRS in Ecuador trying to include that expenses within the TNM base to calculate the ratio. I know that you won, and this is great for the client and for you, of course. I should be proud of that work if I were you. But at the end of the day, I don't agree so much with the theory of excluding that expenses, because of after certain year they should be operating expenses, to my understanding. Yeah. What do you think about that?
Yes, that's why the IFRS 19 considers that expense as operational, totally. But when you request a certification, a tax certification to the IRS, they consider the IRS, they consider this 15% as part of the income tax. They showed in that certification that the effective tax rate is 36.25%. So we also use that as a part of our to show that we're right now with our. Yes. So, and also in the legislation, they say that when you report to foreign companies, that is part of the taxation. And you go to the TP guidelines, and they say, they mention that income tax, it cannot be a part of operational expenses. So you have both legislations, and it's coercive. That's the thing.
Companies, and so the formalities next to the or
Mhm.
attached to the income tax. So well, that helps you to defend the client, and that is expert witness.
Yeah, and other things is we won this case, and we know that there's another case that it's also being won. We still continue to do this comparability adjustment of the 15%. If you have 3 cases that you won, then it's a yeah, you implement that.
I guess that the IRS or the legislators made a mistake of making this payment next to the income tax. They shouldn't be related. And that relation in the law and the income tax return and everything got them in the same trap that they put to the companies at the end of the day. If they were enacted that as a separate thing and a measure to help employees to be part of the gains of the company, they couldn't. They could have made adjustment, and you may be lost or not be into success.
And other thing here, in addition, the comparable companies were mostly for European comparables, and the average income tax rate in Europe is 35%. So if you compare that with a 25% in Ecuador, you need that to add on that 15% to be a comparable tax rate with a comparable. So that's another point to have.
Dear participants, we're really sorry, but time has elapsed for this Q&A session. We're sure that in the next coffee break, you can share your experiences and keep sharing any other information that you would like. Thank you, dear panelists. It was really interesting. It was a really interesting conversation that we had at the end with this Q&A. Before we will have the coffee break, I would like to add that After the coffee break, we will have a really good workshop with Adrian Romero, who is the CEO of Pride Partners International. This workshop will be a strategy session where Adrian will share how he grew his firm 10 times more in less than 5 years. You will learn key points on running an effective firm, diversifying strategically, and achieving predictable growth. So, hope to see you at next workshop. And please, let's go to the coffee break. Thank you very much. Adrian J. Romero. Okay, EF, consulting. EFE, EFA Consulting Group.
joining the association, I probably mentioned that PPI is, laser focused on transfer pricing and valuation services. But a difference between our association and other, let's say, CPA or law firms associations in the world is that we also want to include topics that help your business grow as a company. So not only relying on technical aspects of the practice, but also sharing best practices amongst the members and having speakers that can contribute to topics like sales, marketing, HR, admin, technology, things that eventually will add more value to your firm. So given this is the first conference, I think I have to set the example here and do a workshop about strategy and growth. And probably next year, we will have some other speakers and the agenda might be a little longer so we can include people to address other topics. Traditionally, we know that CPA, law firms, consultancy firms are kind of traditional. You won't let me lie. I started the firm when I was 24. We were about 20 employees after 6 years in business. Everybody focused on transfer pricing. That was the only service that we were offering to the market. And at that point, I decided to focus more on growth, expansion, how to market the firm, how to build a team. And I kind of stepped away a little bit from the practice. I've been related or involved in transfer pricing for like 17 years now, which feels a lot. But I haven't really done some transfer pricing work for probably like 6 years now. Yeah. So I'm still here. It's kind of refreshing to me to be here and getting like a quick update on what's going on around the world. I still understand the language, so I'm not too rusty. But yeah, today's session is completely different. So I need you to really take off the hat of transfer pricing practitioners and put on the hat of business owners, shareholders, partners, entrepreneurs. So if you can do that, you actually have a hat of price partners in the back, so you can really put it on, take it off, and let's talk business now. So the topic is, are you in control of your firm or is your firm controlling you? As business owners, especially running services firms, it's pretty normal that we eventually burn out because we feel like we are the ones selling. We are the ones that have the credibility in the market. We are bringing clients to our firm. And then in most cases, we are doing work. We are supervising our team. We are signing the documents. And eventually we're even keeping track of, invoices and cash flow and payroll and all of it. So we come to a point, and I already see faces like, yeah, that's me. We come to a point where we are kind of stuck because we feel like if we keep growing, I need to stop doing work so I can bring more clients. I can, implement technology and evolve. But if I do that, what's going to happen with quality in the firm? Do I really have a team that's able to perform? I think we are like control freaks that we don't want to leave the operation of the firm in the hands of our team. Sometimes because we don't have an accountable team. We have people in our firm that are executing the work day to day, day in, day out, but we don't really trust our team to run the firm, or we don't have a leadership team. And that's really our fault, because everything good that has happened throughout your firm's history is really, you're the ones responsible for that. Every achievement, every person that you've hired, every new client that you brought to the firm. But at the same time, we're also responsible for everything that's not working very well. So we need to start making change. We need to really, I think, start with our own mindset of, we call it letting go the vine, I think, and make peace with ourselves that we cannot do everything forever. So I'm going to start my presentation with a few industry insights. We work a lot with many as members or consultants with a lot of associations and companies in the world, a lot from the US. And there's one in particular that's called Hinge University. They're kind of like a marketing agency for CPA firms, but very well known in the US. And they publish a yearly survey with, I think they survey over like 1,200 firms in the US. And not only the US, because now they are also working with CPA and, associations. So they're getting data from many, many parts of the world. And they publish their survey, and it provides us like access to see what's going on with other firms in our industry. If we need to do a benchmark, because we talk about comparables, are we actually comparing ourselves to other firms? In most cases, we're not. If you go to the I don't know, Accountants Association, the Economists Association, you're probably going to be talking about technical topics like today. But have you ever asked your peer next to you, hey, how much does your firm does in revenue? What's your profit margin? What are your top, services? What are you planning to sell this year? Rarely, right? Rarely or never. So the survey gives us access to that information, and I think it would be very nice if eventually we can come up with our own survey within Private Partners, so we can also have a benchmark study of how every firm is doing. We have that information from your firm's application, so we know that, but if it would be really cool if we can update it and share it without names, but just numbers throughout the association, so we can have a good idea. So I only extracted what I think is the most valuable information for you today, and this is the first. Pleasure. So median growth rate by industry. So the industry, and this is not a surprise, that grew the most, again, is technology and software. But after that, we have consulting, accounting and financial services, and law firms and legal services. I think everybody's getting a cold from yesterday. So 11, 10%, and then you have government contracting, architecture, engineering, construction. So our firms as transfer pricing practitioners, some of you have CPA firms with a transfer pricing practice, some are lawyers, some others are fully specialists in transfer pricing, and that's their core. But you might be in one of those three. What happened here? Does it work? It does work. You either consider yourself a consulting firm or an accounting firm or a legal firm. That's for sure. And there's not a big gap between the three of them. So that's the median growth rate, right? So looking back at 2022, and just raise your hand, you don't have to say anything. Did your firm grew more than 11% in 2022? Raise your hand if your firm did. Okay. Raise your hand if your firm didn't. Okay, so that's like maybe 60% did, 40% didn't. Okay. Now, if you look at profitability, also by industry, these are the margins, 25, 25, 22, right? So, and this is obviously operating net operating profit. So you can see a good benchmark there, 25% as a median. And then if we look at that information organized by growth category, what does this mean? The one on the right side, the green one, says high growth. So high growth are considered firms that grew at least 20% during the last year. Okay. Oh, not only the last year, it's the average of the last 3 years, actually. So more than 20%. So high growth firms actually grew 34.5%. That's the median. Then if we look at average growth from 1 to 19 was 9.5, and then no growth, which is under 1%, then it's minus 6.7%, right? Now, if you look at profitability based on growth, you'll find that high growth firms were at 27.1% versus no growth, 18.8%. So if your firm is doing more than, let's say, or in between 18 and 27%, you're well, amongst the majority of the market. If your firm is doing over 27% in profit, then you're as profitable as one of those high growth firms, right? Now, based firm size based on growth category, so you'll see that micro firms under 1 million in revenue, which that might be kind of typical for Latin America. High growth firms are doing 31% growth versus no growth. No, this is not firm size based on growth category. Okay. So this is the firm size, right? So most of our members will be considered small firms to mid-sized firms. All of us, basically, with maybe a few exceptions, are between 1 million and 50 million in revenue. So those are your numbers right there in the middle, between small and mid-size. Firms that are doing more than 50 million in revenue typically are US firms, and not everybody, of course. If you look at like firms in Latin America, for example, 96% of firms are doing less than hear this, $60,000 in the entire year. So that's a solo practitioner that's like self-employed, managing a few clients and, keeping up with bills. In the US, 96% of firms are doing less than $500,000 in revenue. So considering someone in the US earns, let's say, anywhere, depending on the state, from 60K to 120K on average, that firm might have 2 employees, 3 employees, 4 employees, and that's it. So who would consider their firm a consultancy firm? Raise your hand. Okay, the majority. Who has an idea of what's the average number of employees in a consultancy firm worldwide? Somebody want to take a guess? The number of employees on the average consultancy firm in the world. 20. More than 20? Less than 20? Less? 8 employees is the actual number. 8 employees. So the average consultancy firm worldwide has only 8 employees. Now, anticipated business challenges in the next 3 to 5 years. Okay, so this information this was published a month ago. Okay, so this is very, very current. For this year, which is the blue line, says 36% are answering the need for new skills. And this is not new. For the last 5 years, and I don't know who's from the US. You're coming from Canada. We have from the US here, and also in the back. For the last at least 5 years or 7 years, everybody in the US was talking about automation, right? Oh, all the accountants are going out of business because software is going to take over bookkeeping and audits and everything else. So now you're going to become risk advisors. And they were saying that 99% of the work would be automated, and everybody was really scared. And the horizon was actually 5 years. So 5 years already passed by, and I still don't see that happening, but it is evolving. That's for sure. So the need for new skills has always been there. CPA firms trying to kind of like convert into consultancy or advisory firms. Particularly in the US, you'll see a lot of big 4 firms acquiring technology firms, acquiring marketing agencies, acquiring law firms, because they know they need to diversify, and they also invest heavily in what they call future-proofed services. It was, I remember it was a trend, cybersecurity, for example. So you would see like EY is investing $100 million in hiring people to train them in cybersecurity because that's the future. And that's always been one of the top priorities. Number 2 challenge, right now everything is unpredictable because after COVID, and especially in some countries, India, Singapore, the US, Canada, are amongst the 6 countries in the world with the highest percentage of employees at risk of attrition, for example. So this means that the employees are thinking of quitting their job in the next 3 to 6 months. Before the pandemic, the horizon was 2 years. You would ask anybody that you just hired, how long do you see yourself in the firm? At least 2 years, for sure. Right now, people are answering 6 months. I don't know what's going on tomorrow. So they don't want to commit, right? And you have issues like the Great Resignation, people quitting their jobs. 2 to 3% of the entire workforce was quitting their jobs every month because of the pandemic. CPAs decided that they were becoming artists or musicians or going after different passions, right? Other people, so I'm not gonna work anymore, especially if your country is giving you like unemployment, checks every month. But the Great Resignation transformed itself into other, topics. Right now, everybody's talking about the quiet quitting phenomenon, right? Or quiet quitting and quiet firing and quiet everything. But the quiet quitting phenomenon represents that about 50%, and this is according to Gallup, 50% of the entire workforce, in the world is considered a quiet quitter. Quiet quitter means that I'm going to work from 9 to 5 p.m. I'm going to shut down my computer, and I don't want to have an email or a call related to work because I want to have that balance, right? So quiet quitters are now, it's kind of the opposite to the hustle culture, right? And it's actually costing the economy $9 trillion in lost productivity. So we have a lot of issues, and the market in general is very unpredictable right now. And then, related to that, a shortage of talent. You'll see a bunch of people, businesses, both small entrepreneurs to public companies, really struggling to find the talent that they need. I actually, before coming here, I did a kind of like a case study. I reached out to 20 CPA firms from California saying, I have this company and I'm looking for a service provider. I need bookkeeping, tax filings, audit, everything. 20 firms last week I did it. Only one firm replied, yes, let's have a call, but in 2 months, once tax season is over. 19 firms, not everyone replied, but every other firm that replied said, I don't have the capacity to have new clients right now. So if a good client is coming through your pipeline, inbound, you're not putting any effort to it, and you're saying, I don't have the capacity to bring you on as a client. How many times does that happen? How much money are you losing? How much growth are you sacrificing because you didn't prepare, you don't have talent, you're not good at retaining people, developing people, nurturing your clients, you're not doing cross-selling, upselling, and everything else. So the shortage in the talent market is not a US thing, it's not a Mexican thing, it's a worldwide issue right now. And then you have other things that you can see there in the chart, and we'll send the PDF file of this so you can read through it. And then you have trends and topics to learn more about in 2023. Number 1, 35% responded workflow and process automation. Because if I cannot find people, well, let's have a machine do it, right? Who's using AI already in their firm? Oh, that's good number. So that's number 1. Then you have strategy, number 2. And then you have digital transformation, right? So those are the trending topics for the year. And then you have, this is very interesting as well, portion of leads generated from digital sources. Huge number, 40% of leads. So if you're a CPA firm or a consultancy firm saying, well, I don't do marketing because I get my new clients from, referrals, recommendation. I do maybe a workshop and I get a couple of new clients. That's not enough in today's market. 40% of leads are coming through, digital sources. Meaning, are you doing good content creation? Are you investing heavily in SEO? Are you doing paid media? Are you doing, are you implementing all the basic tools of marketing and technology to drive more business to your firm? Or are you still relying on traditional methods like, let's have one of our clients recommend us? And in some cases, you're not even asking your client to recommend you. You're just waiting for that to happen. So we need to be very proactive in terms of talking to our clients, understanding what they want, what they need, serving that, and then actually asking our clients to recommend us to other businesses. Because most likely your client is playing golf on Sunday morning with other business owners, and they will likely talk good about you if you're doing a good job with them. So that's just like the intro. I know it's for a lot might be depressing, for others might be exciting, but that's what's going on. Now, as firm leaders, and I don't know if everybody here, like who's a shareholder in their firm? Can you raise your hand if you own shares in your firm? Most of you. Now, keep your hand up if you are the managing partner, the CEO, or the majority shareholder. Again, the majority. Okay, good. I don't know if you see yourselves as tax experts, tax practitioners, or actual entrepreneurs, but most of you will probably say, yeah, I look at myself like an expert, a tax expert. I do transfer pricing and I'm really good at it and I'm a tax expert. But only a few will actually answer that they look at themselves as entrepreneurs. When you change that mindset from you say working on the firm, right, or in the firm to working on the firm, everything changes, because then you can actually take some time to develop and grow the firm and not be all of the time stressed because you're hitting deadlines and work is coming and audits and issues with clients. There needs to be time for everything. So there are three concepts that I want to share. Well, number one is hitting the ceiling. What does hitting the ceiling mean? Hitting the ceiling is basically a phenomenon where everybody here, every organization, every team, and every individual, eventually from time to time, will reach a point where you're feeling, frustrated because you don't know what to do next. It feels like you've tried everything. You don't know what's going to happen. You're not getting different results. And that moment in your life, which, happens a lot of times, and that can happen, at a personal level, at a family level, or at a business level, is considered or called hitting the ceiling. So there are two options when you're hitting the ceiling. Either you stay there in your comfort zone and eventually go down and die, or you die quickly, or you evolve. And if you decide to evolve, there has to be a transition, which is called a revolution period, to then acquire that evolution period until you hit the next ceiling, which is basically going to happen sooner or later. So hitting the ceiling is something that happens to a lot of firms. I work with a lot of firms in Latin America. We probably have strategic alliances with, you told me the number, Francisco.
Probably between 120, 150.
120, 150 firms in Latin America that are referring clients to us and we have relationships with. Some of those clients were in the market for 20, 30 years, already second generation, and the firms have been stuck, for 10 years, no growth. They're doing okay. They're profitable. They live there from the firm. They pay private colleges, whatever, but they're stuck. What happens to one of your employees or new employees, new hires, when they come to your office for an interview and they see that the firm hasn't really grown in the last 10 years? Is that exciting for them? Of course not. They're going to be there because they need a paycheck, because they want to learn something. And once they have a first opportunity to leave, walk out the door and go to another firm, they will do that because they want especially right now, people want to, develop continuously and they want to be part of a winning team. So they need to see that the firm is always evolving. So as business owners, you also have to master what we call the 5 leadership abilities. And I'll share with you what are those 5 leadership abilities. And then also find what's your unique ability. And unique ability, there's a great book called Good to Great. Some of you might have already read it, but it talks about the hedgehog concept. So it's finding your unique ability as a business owner. And it's not, oh, my unique ability is that I'm a transfer pricing expert. It's not that. It's something different in the way you do business, you serve your clients, you treat your employees, something that you're doing differently from every other firm in the market. So you got to find that and really maximize it so your firm can, continue growing. So in terms of the 5 leadership abilities, these are the 5 basic that you master them and learn them and practice them. And the first one is to simplify things. And this is gonna hurt, but obviously as tax experts, advisors, sometimes we overtend to make things complicated because it makes us look more smart or prepared. But in reality, what we know is that we have to dumb things down. Every time that we're with our client, what our client values the most is that we're able to take a complex topic, make it very simple for them to understand and implement. So if we're able to simplify everything from the emails that we write to the instructions that we give to our employees to the way we present, that's going to help a lot. And why is simplifying so important? Because growth might be linear, ups and downs, but eventually it's a straight line. And complexity is actually exponential. Think of this. If you're starting your firm today and you have one employee, how many lines of communication are there? Just one. Between you and your employee, direct communication, that's it. Then think of adding your second employee. Now there are 3 people. How many lines of communication are there? Now you have A to B, A to C, and B to C. So you only added 1 person. You grew what, 50%? Because you were 2, now you're 3. Yeah, your payroll expanded by 50%. But what about complexity? You had one line of communication, now there's 3 lines. So it grew 300% or 200% instead of 50%. So growth, as you keep adding people, it comes to a point where the issues that you face when you're a team of 20 will not be the same when you're a team of 50 or 100 or 200. Everything is different. So keeping it simple really helps. And I don't know if you heard the acronym KISS. KISS. What does it stand for?
Keep it simply. See, I forgot the other S. Keep it simply. Shit, simply, something like that.
Who knows that? Stupid. Keep it simple, stupid. Right. So keep it simple, stupid. Right. Then delegate. Delegate to elevate. Delegating means that you gotta find the tasks that you are doing on a daily basis that either you don't love or you're not exceptionally great at doing. If you're doing a bunch of stuff like, maybe billing your clients or checking the bank accounts or paying vendors or stuff like, I don't really love this. This is not where my time is supposed to be. I'm not even good at it. Those are things that you need to start delegating quickly, right? So you can do a list of your activities every single day for a week and then create a chart and say, here are the things that I love doing and that I'm great at doing. Here are the things that I don't love doing so much and I'm not that good. And then here are the things at the bottom that either I hate doing or I'm really bad at doing. So everything that comes to the bottom of your chart has to be delegated to other people who actually love doing that or are really good at doing that. 60% of your time doing things that you don't like or you're not good at, that's a bad investment of your time. Now, the ability to predict, right? Short and long term. In today's world, short term, 7 days, long term, 90 days. Working quarters, that's the key. So the ability to predict really helps. Even revenue has to be predictable. If let's say you land huge clients tomorrow and your revenue grows 300%, you're going to implode. You don't have enough capacity, people, systems, technology to handle those clients. And what looks like a great opportunity is actually going to be the end of your firm. So predicting is great because you're going to be more proactive instead of reactive. You're not going to be driving the car looking through the rear mirror because you're being reactive. You have to be more proactive. So it's got to be data driven and look at patterns and make decisions based on what can you anticipate, not what already happened 2 months ago. And then systemize, is basically identifying your core processes in the firm, only the core. So you know the Pareto rule, 80-20? Really? 80%, 20% of what you do has an impact of 80% of the result. So it usually applies for everything, 80-20. So identifying that 20% of your processes that are really driving your firm, documenting that in a simple way, and then having everyone follow them. If you're not able to standardize everything at the firm, everything that's relevant and important, then the experience that your employees and your clients are going to have with your firm is going to be so different that it's not consistent and you will not be able to grow accordingly. So that's key. And number 5, structure. So one of the things is, yeah, employees come here, they work for a while, and then they quit. They're quitters. No, they don't know how to work. They don't care about their job. They don't care about the firm. They're not going the extra mile anymore. And it all starts with how we recruit people, how we select people, how we train them, how we onboard people, how we treat them, how we, develop them. But the number one thing that we need to really invest in, and it's more time than money, it's creating an accountability culture in the firm where eventually you don't have to be supervising every single person to make sure they're doing their job or they're doing it correctly. So if we're able to create an accountability culture in the company, then everyone will know where we're going. They know how to do it because they have processes in place, and they will actually do the job the way they're supposed to do the job. So accountability is crucial. And results driven, obviously. That will drive your results. So if I put everything in the blender and I come up with, how can we really grow a firm? We grew from 20 employees to 200 in just 5 years. At the same time, I had like 3 or 4 kids, and then, a bunch of things happened in life during 5 years. But these are the things that I can share that work for us and work for a lot of our clients. So number 1 is the way you're managing the firm, obviously. And what, some things that does, managing includes having clear core values. And for a lot of you, core values is just like a paper on the wall that looks, pretty when somebody goes into your office. Core values is actually crucial to building a solid foundation in your company. And when I say core values, there's a good document that's called the 3 core values traps. It was written by Lencioni for Harvard Business Review. And when you think of core values, a lot of you will say responsibility, commitment, teamwork, quality. Am I right? Like if I go to your websites right now, are those the words that are going to be there? Yeah, in most cases, that's true for any company, not only firms, any business. So in reality, those are permission to play values. If you don't have quality, why would I even work with you? If you don't work as a team, if you're not responsible, if you're not committed, those are permission to play. You must have them. So they are not the real core values of your firm. So starting with that exercise, moving down to core focus, a clear vision. The vision has to be shared by all. In some cases, if I talk to you and one of your partners and I ask questions, and I only need to ask 8 questions separately, most likely, even if you swear that you and your partner are aligned on the same page, you're going to be on different pages in most cases. Now, if I go down to your receptionist or one of your staff members and I ask them about, like, hey, what are the revenue goals for the firm this year or this quarter? What are our profit goals, right? Or what is our marketing strategy? What is it that we do at the firm? Most likely they won't know, or they will give an incorrect answer. And the reason is because as business owners, we don't have a clear, simplified vision. And number 2, we're not making sure that everyone in our team is sharing that vision. Then having right people in the right seats. I'll explain that in a few minutes. How am I on time? Okay, still have like 15 minutes. Processes, a meeting rhythm, data, then leadership skills, solving issues, developing culture, leveraging tech, compensation plans, training and development. Seems like a lot, right? On top of doing work, right? So all of that is firm management. Now, if we just look at firm management, there are 6 ways or 6 key components, key functions that if you take care of those and you really make sure that this is healthy in your firm will change dramatically. Number 1, having a clear vision and that vision being shared by all. Building a data-driven organization, not emotionally driven. I don't know in your countries, because European countries will be very different from Latin American countries. But in Latin America, when you see a good deal, you say, well, is this really a good deal or not? And usually you're listening with your heart, with your gut, right? And if it sounds good, well, let's do it. Let's try it. So we're not used to making decisions on data. So having scorecards, having KPIs, having everyone in our team have a number on their back so they can be accountable for those numbers. Then talent, probably the biggest issue. Having the right people in the right seats. What is right people? Right people means people that really share your core values and are a good cultural fit with your team. It doesn't matter if that person is great at transfer pricing, but if that same employee is creating a cultural problem within the team because they don't align, they don't share the values, they don't really integrate into our team, that's like having an in-house cancer that you're developing there. So eventually that's gonna eat your business and you need to make the hard decision of letting that person go, even if they're great at doing the job. Now, right seats is the opposite. Right seats mean that the person is good at performing their work. So what do we need as businesses? We need somebody to be both, to share the values of the company and do a great job. So going through an exercise, evaluating, assessing every single individual in your team, it's a great exercise. There's a way to do that. And you'll find out that, there might be some core values issues or people that we know that they're in the team, but we should have fired someone probably a year ago and they're still there, right? Because we're afraid of making the change, making this adjustment, or because they don't perform well, but everybody loves them. So if I fire them, the morale is going to go down. In a for-profit business, it doesn't work that way. Then you have standardizing process, basically. I already explained that. Solving issues, for example. There's a limited number of issues in the business world. We might think that those are, there's unlimited. No, there's a limited number of issues. A lot of books will say that there's about 160 issues in the business world. And most companies will be sharing the same issues. Either if you're Apple, you might be struggling with something related to talent, the same way someone with a 5-people company is struggling. So solving issues, we need to have a way of, identifying the root cause of every single issue, then working on that cause and solving it once and for all. If we are just putting out fires every single day, we're doomed. So we need to learn how to identify the root causes and get that solved. And lastly, organizational effectiveness. How do you set your goals? A lot of clients say, well, because I want to sell 20 million. And why is that? Because it's a good number. Or because I want to sell 20 million, or because that way I can buy the house that I want, or they don't have any reasoning or anything that makes sense in order how do you get to that number? How do you break it down in quarters? What do you have to do to get there? It's not only where we are right now and where we want to go, it's how are we going to get there? So having clarity on how to establish goals. And then the other thing is, meeting effectiveness. How would you rate your meetings at your firm, internally, with your teams? Like, who would say between 8 and 10, 8, 9, or 10? Effectiveness. How do you measure effectiveness? Are your meetings following a standard structure? Are they always the same day, same time? Do you start on time? Do you finish on time? Do they come out with, action items that are solving issues? Are people feeling that the meeting was really productive? Or are you having more meetings where you get out of the meeting and, man, this could be an email? Or, we spent 2 hours in the meeting room and we didn't get to anything. We're just going around and around and around. A lot of, discussion, but no actual solutions. So who would rate their meetings between 4 and 7? Raise your hand. Nobody said 8 to 10? No one? Okay. 4 to 7? Less than 4? Like 0 to 3? What about the others? You don't have meetings or what? I mean, you're doing great if you don't have meetings. Eh? Well, just so you know, 100,000 entrepreneurs are surveyed every year, and the answer is usually 4. So they are rating their meetings as a 4. So you have to improve the way that you handle meetings so they become a 10, right? And there are ways to do that. And now, if you look at services, which is another major pillar in every firm, what are we doing? What are we selling? Are we selling what we want to sell, or are we selling what the market is asking us to sell? So the way that I see it, and this is something that comes from my own experience, is that I try to categorize our services in 4 places. I compare profit versus face value. If we are in the ideal world, I would be selling only services that are high face value with high profit. Now you have high profit, low value, low profit, low value, low profit, high value. Where are your services located in the chart? Think of that. Right? So, in my opinion, a healthy firm would look like this. Each yellow dot is a service, right? So you have services here, entry type, that are to differentiate ourselves from other competitors and put, one feet inside a new client's door. You might have 1 or 2 of those, like great diagnostics, for example. Not necessarily free diagnostics, because I know it's very common for you to say, hey, yeah, let me do a free diagnostic of your transfer pricing compliance. And then once I show you that I'm better, you're going to ask me for a quote. That's very normal. So it's not necessarily free, but they are entry type services. Then you might have some generalist compliance work, like bookkeeping, for example. Is there a real difference between hiring a bookkeeper, paying a monthly fee, or just paying $15 for QuickBooks, for example? So those services might be delegated to low-cost countries. A lot of CPA firms from the US and Canada are hiring people through us in Mexico to handle that type of work that's not even profitable anymore in the US. So you handle that. Our team over there does the work. It's profitable. And then I can focus my team in other types of services in the US. So that's another thing. Sophisticated compliance work. You can try to automate a lot of that, or part of that. And then you have consulting services where it's like the holy grail where a lot of firms are trying to move, and that's specialized. So yellow dots are the way I look at it. Where do you think transfer pricing is right now? Might depend on the country, but the laser doesn't work. But it does work, but it doesn't it doesn't show on the screen because of the light. Would transfer pricing be here? Yes or no? No. Here? No. Here? Well, raise your hand if you say yes. One, partially. Here? In my opinion, transfer pricing started around here, and then it's kind of like doing a curve, and it looks like this now, right? When we were starting, let's say 15 years ago in many countries, transfer pricing was a very specialized service. Not every CPA firm did it. Not everybody was a practitioner. You had to learn accounting and finance and economy, and it was really a very, very highly skilled technical profession, right? So we had to develop the talent. Now, as we started having, access to trainings and workshops and more attrition from big four firms, then everybody is an expert now, even in small firms, and everybody's trying to do transfer pricing work, and it's really making the market more challenging. So it's moving here. But I was asking yesterday to our guest from the OECD if she thought that transfer pricing would eventually be fully automated. Like, if you can come up with a software that produces the ranges, and then at the same time you have tax authorities like the Mexican one giving you annual guidelines of what a tax effective rate looks like for every industry, and if you're below that, then the chances of having an audit really increases. So you want to be in that range. So if now you have a range from the OECD guidelines and another range from your local tax authority, then the gap really closes. There's not a lot of flexibility, right? So, and you have rules that say that you cannot adjust. So can't a software fully automate that work? Where is our criteria or experience? She told me, fortunately, that no, that we still have at least 10 more years of work. But that's a question that's in my mind always. And lastly, firm expansion, right? Marketing, business development plan, CRM, CMS. Just hear the names and think if you're doing it. Paid media, events, good marketing qualified leads, sales qualified leads. Who's my buyer persona? What is my customer acquisition cost? What's a good conversion rate? How to cross-sell? How to upsell? Nurturing clients, calculating your total addressable market or serviceable addressable market or service addressable market, healthy churn rate, shortening the sales cycle, the lifetime value of your clients. They say that the magic number is 5. If you can have a client and you're cross-selling up to 5 services to the same client, chances are that 98% of the times the client will stay with you for more than 5 to 7 years. If you're only selling to a client one single service, chances are about 40% that the client will leave after a couple of years. So firms will try to sell more services, obviously in a healthy way, but trying to sell more services to the client. So last, some tips here. Mindset and budget must be aligned. What percentage of your annual sales are you investing in marketing? Who can share the number? What is your marketing expense versus sales? What's your ratio? I'm starting to get worried. Between 5 and 10? Okay. 5? Who's giving more? More than 5? 1%. More than 10? Anybody? No? Okay. You remember the statistics at the beginning. High growth firms are investing 15% of their annual sales in marketing. 15. What is the no growth firm rate? 3% or less. So if you want to acquire, like, let's say, medium or a good growth rate, it's going to be between 3 and 15. Over 15, that's only like high growth firms. Now, developing a smart marketing plan. Who knows what SMART stands for? I know Francisco does. Anybody? Francisco, you tell us. Please illustrate.
I'm not sure I'm gonna remember all the letters, but it's measurable, acquirable. Oh, yes, yeah, that's why I was skipping it because sexy, yes, specific, measurable. I already said acquirable, tenable, and the R I can't remember honestly. Realistic, yes.
And T?
Tenable, right?
Time bound.
Oh, time.
So all of your goals, including everything in your marketing plan, has to be smart. So you can do a smart checkbox and make sure that your goals, when you're writing down your goals for your firm, not only in your marketing plan, everything, becomes specific, measurable, attainable, realistic, and time bound. We want to grow. Yeah. How much do you want to grow? By when? So it has to be very, very specific in order to make sense. So, number 3, defining your proven process. What is your proven process? That's the roadmap of how your clients how the experience of your clients will be. What can they expect when working with you? From an initial consultation to maybe signing a proposal to getting the work done to just client customer service. Like, what is your personal roadmap so clients can know what they can expect? And then connecting the marketing and the sales process. A lot of issues come from a disconnection between sales and marketing teams, as you know. They will be throwing the ball to each other, and you need to find a way to make this efficient. If you do great marketing and you're getting a lot of inbound leads, for example, but then you have a gap with your sales process, then those leads will not convert. So it has to be streamlined. So leads are coming in automatically. We have good filters in place, and then our sales process is great. So our conversion rate is good enough. If you're looking at ROI, for example. And then number 5, use marketing automation and analytics. What is not measured, what cannot be improved. So you need to keep track of all the data and everything you do to understand where are optimize that segment so your entire process becomes more efficient. And lastly, to conclude, our industry is evolving. And if you don't believe me, just take a look at the next slide. Go to TikTok. I don't even have a TikTok account. But if you go to TikTok, just search transfer pricing. And now you'll even see videos of people explaining transfer pricing in a TikTok video, having thousands of hits, because that's now a marketing tool that you need to use. So you're probably stuck with webinars that nobody's attending anymore, right? Or maybe you're doing some in-person workshops from time to time. But what about social media? Well, social media in some cases is basically to have some brand exposure, or TikTok videos, which is right now is like the new Facebook, and everything goes viral, and you just put a few dollars and it really has a good reach. Is anybody doing TikTok videos? Personal TikTok videos? You do?
My firm just started.
Yeah.
Not for transfer pricing, but
Yeah.
for law in general. This is a pilot project, and I will see it. But
Are you in the
I'm not
videos?
doing the videos. So. I'm improving them. But that's it.
Yeah. And yeah. So that video, I watched it yesterday, the first one. And that's a guy that's telling somebody, well, it's very easy. Just open a branch in, I don't know what country he mentioned. It wasn't Panama, because everybody was. And you just have to build $20 million and move that money over there so the profits are there. And then they cut the video, and a transfer pricing expert comes in. It's not that guy, it's a different guy. Or is it? I don't remember who. Yeah, it was that guy. Yeah, it's the same channel, right?
Yeah.
So then he appears on screen and says, "No, you cannot do it because transfer pricing rules say that blah 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 blah." And yeah, that's it. That's like a quick transfer pricing lesson in like a minute. So that's the new way, right? So I think that's everything. We do this all everything that you saw. We do it with a lot of firms. As like I said before, I don't do transfer pricing anymore on a daily basis. What I do is I run the consulting practice at our firm, like management consulting, and I work personally with CPA firms and law firms, basically implementing everything that I just told you. But I'll send the presentation over so you can take note, and you can do whatever you want with it. And that's it. Thank you for your time.
Thank you, Adrian. Adrian J. head of transfer pricing at Outokumpu Group. Sana has 20 years of experience in transfer pricing and international corporate taxation by working for Outokumpu Group, tax authorities, competent authority, and a Big Four. She is also experienced in dispute prevention and resolution, and prior joining Outokumpu, Sanna worked for Finnish competent authority, negotiating by and multilateral APAs and MAPs. In addition, during those years, Sanna was Finnish delegate to EU Joint Transfer Pricing Forum, OECD MAP Forum, and Nordic Cooperation in Transfer Pricing. Thank you for joining us. And the last member of our panel is Jaime Linaza. He is head of transfer pricing at Iberdrola. With more than 12 years of experience in transfer pricing, Jaime is leading the global transfer pricing team at Iberdrola. Prior to joining Iberdrola, Jaime worked for 7 years as a transfer pricing specialist at EY Madrid and 2 years at EY Houston, Texas. Since 2010, he has gained extensive experience in dealing with topics related to transfer pricing, both from a professional and an academic perspective. Jaime is responsible for defining and implementing the worldwide transfer pricing policies, supply chain assessment from operational transfer pricing perspective, designing, implementing, and managing the global transfer pricing models reflecting current BEPS development. Acquisitions integration, pricing of intercompany financing transactions, supporting APA negotiations, mutual agreement procedures, supporting Iberdrola's business team in the definition and negotiation of terms and conditions on their joint venture structures with third parties, and global automation of operational transfer pricing. He is specialized in the energy industry and areas such as project financing, restructuring, or intangible valuation. Thank you and welcome. Each of the members of this panel of discussion also will have each 10 minutes to develop their presentations. And at the end, we will open a Q&A so our public can make comments or ask questions to the panelists. So, Krishna, our transfer pricing lead at DSM, the floor is yours.
Thanks. Just to be clear, am I audible properly?
Yes.
Yes.
And can you also see me or the?
Yes.
Yes, we can see you.
Great. Thanks. First, my sincere apology. I actually wanted to be there physically here, but due to some really other important office work, I couldn't travel from Netherlands to Paris. Otherwise, I would have loved to join there physically. How do we do? Can someone upload the presentation?
Yes, the presentation is already uploaded, and you only need to say next when you want to pass from one page to the other one.
Okay, next, because I only see the room, but I do not see the presentation.
Let us help you with that. Sorry.
You can share screen. Yes, you
can share your screen.
You can share screen, and that's enough.
You can open it.
Sorry?
You can open you can share your presentation.
No issues. Then I have the presentation in front of me, the physical copy, so I can basically look at my physical copy, and then you can move from one slide to another. Is that okay?
Yes, sure.
Yes, it works.
Yeah. So I think we can skip the introduction slide 2, because that's already done. You've already introduced me. Then we can move to slide 3, which is the title, the beginning. Is it on the screen?
Yes.
Yeah. So if you see here, the entire change in international taxation actually started post financial crisis after 2008, and then also a lot of major economies went to OECD to basically request them to look at the international taxation law. But what really changed? What triggered that? The key trigger was over decades, the way the organization were doing business significantly changed. It became more international and not say in one country, but the transactions were across globe. And also a lot of transactions were digital. Big digital companies like say the Flipkart, Netflix, and other companies emerged globally. And also there was no clear guidelines to tax them. The tax laws were really built up in 1920s and 1930s. Now, based on that, OECD came up with the BEPS action. I think that was the key starting point of all the change in the international law. Based on the BEPS action, I think OECD initial assumption was, most of the tax planning or the tax structuring would basically end. Probably that was a bit of an optimistic assumption, especially because in one of the key things, which is the taxing the digital economy, there was no consensus. Even today, there is no clear consensus on how to tax the digital economy, and with the Pillar 1 rules still not being finalized. What happened in between, a lot of companies started using a one-sided tax, like say UK added a diverted profit tax. There were one-sided tax from India, France, Australia, and other countries. So the solution which OECD was trying to have on international taxation, no double taxation, but also no tax evasion, was not fully implemented. But a lot of compliance and other things increased. Now after 2018, BEPS 2.0, there is additional layer of taxation. One is, of course, the Pillar 1, where the rules are being framed. Pillar 2, which is now almost a reality. Also, now most of the companies will now have to see how to implement those Pillar 1, Pillar 2 rules. So I think the BEPS was basically the starting point of all the international tax things, but then a lot of new rules also slowly started coming. If we move to the next slide. I cannot see, but I'm assuming that the title is Impact of BEPS on Transfer Pricing.
Yes.
Yeah. So now, as this is a transfer pricing seminar, let's quickly touch upon what were the key BEPS action related to transfer pricing. The key BEPS action related to transfer pricing was mainly on action 8, 9, and 10. The key point of that action was value creation. The idea was via these transfer pricing actions to ensure that the operational profits should be aligned with the economic activities. So one of the probably the easiest or the simplest example is the IP structure. Previously, a lot of legal IP could be in one location, and a profit could be allocated to that location based on that legal IP. What has changed is basically now to follow the DMP function. So the profit related to IP should be in the jurisdiction where the DMP function is. that's basically one of the key change of putting all together the BEPS action related to transfer pricing. So the key is basically the operational profit should be linked to substance and not form. Now, what does it mean? It means for most of the organization, they had to look at their say transfer pricing model to see whether the transfer pricing model is closely aligned with the business model and not something they can just build something on the paper. And and in the next slide, we will see what kind of an say impact it had on the M&Es. But along with this BEPS action 10, 8, 9, and 10, which is more about the value creation, there's also action 13, which is the three-tier documentation. So a lot of compliance increased, where we had the CBCR, the master file, local file. Now, to bring in the complexity, there are different rules and regulations in different countries, even with local files. There is no standard way of doing local files. At the same time, the benchmarking, there is also not a standard way of doing benchmarking. Different countries have different rules related to benchmarking. Some look for a 3-year average, some look for a 1-year average, some are okay with regional benchmark, some needs kind of a local benchmark. So the BEPS action also trigger a lot of new compliances. And also what I have seen is post 2015-16, the tax litigation or the questioning has also significantly increased. I think those were the kind of a summary of the BEPS action on transfer pricing, and then let's try to see what is the impact on the M&Es. The last slide, the third slide. The impact on M&Es. Yeah. I think the impact on M&Es are twofold. With say all kind of news about taxes about the big companies, the top management also started say looking more carefully on the tax function. At the same time, the in-house tax function also started working a bit differently post BEPS. In a lot of companies, the in-house tax function was more kind of an advisory. Now the in-house tax function is more kind of end-to-end. They now have to be more closer to the business, be part of the business model, business discussion, give inputs to the business people that depending on the business model, what would be the tax impact, connect more with the HR related to the location of the people, and also basically have a closer look on the compliance, because the compliance also needs to be very uniform. The documentation at country level and the central level also needs to be very, very uniform. So I think one of the biggest change was basically how an in-house tax function was working. From advisory, now they are working more end-to-end, being part of the business, being part of the compliance, being also part of the technology implementation. I think that was my summary.
Thank you very much. Krishna Gupta, Transfer Pricing Lead at DSM. Thank you so much. At this moment, we will present Sanalai Noya, Global Head of Transfer Pricing at Outokumpu Group. So the floor is yours. Thank you.
Thank you. And I also like to thank you for the opportunity to talk to you. And it's really nice to meet you all. And the slides that I have, maybe we can take the first one. Yeah, thank you. Yeah, actually, the first slide is here to kind of put into the perspective the ideas or on the impacts that I have. And basically what we are, Outokumpu is a global stainless steel manufacturer. We have a mining operations also in northern Finland. So basically we're EU-based, EU headquartered group. And that means basically that we have the regulations coming from the EU and the OECD. But since we're present in about 30 jurisdictions, we also have the local regulations that come from those countries. And basically we're a listed company, and net revenue is close to 10 billion. So basically it means that we're in the scope of Pillar 2, but not in the scope of Pillar 1 amount A. So that's kind of the background, and that was kind of to reflect the ideas that I have on the impacts on the M&Es. And of course, as Krishna was kind of covering the BEPS items, and I'm kind of now in a way looking into the future trends maybe, because I mean there is no escape of Pillar 2. We're based in the EU. We have the EU directive. It's just waiting for the local legislation, and that there is a compliance exercise that we've never faced before. We've had items, BEPS Action 13, mandatory disclosure requirements. Those were something we had to scratch and put into place, but that was nothing close to Pillar 2 exercise. It is, and it's not too much time either. It's March now, and basically thinking about Q1 reporting in 2024, we need to be calculating the taxes correctly. So there's only a year left. So anyone who hasn't started should start, but anyway, the impact assessment is the first thing that I've been thinking about it, and it is actually the most time consuming, because I'm thinking about is that if you kind of split it into like in the calculations, the catch is in the data. For example, for practical experience, what we have is that we are a result of historical consolidations. We have multiple legacy ERP systems. We have elderly consolidation system. That is not an easy exercise. We need data from the consolidation systems, from the from the SAP. We need data from the treasury, we need data from HR. And that is the kind of the tricky part of this. And in a way it lands on a tax function, but it's a joint exercise with the finance, treasury, HR, legal. And yeah, when we actually get the data, the calculation itself, I don't think that is as tricky as the data sourcing. Of course, the detailed rules, complex detailed rules, but of course that is something that is, I see, more doable. And luckily there are at least transitional safe harbors that we can utilize for not having to calculate all the 30 jurisdictions in such a detailed level. And when it comes to Pillar 2, the first exercise, there's no escape either from the fact that it's a manual exercise. There is no system that would actually be able to cover rules that are not existing at the moment. It's a bit difficult to buy a system. And of course, the filing itself, the globe tax return is not an easy piece of paper. And then, of course, that comes to the company itself. It depends how you organize your tax compliance. Some companies do it in the tax function. Some companies have it on the finance and controlling. And if it's on finance and controlling, there's a lot of education you need to do for them to be able to prepare the jurisdictional globe tax return. So basically, that's why I kind of took the Pillar 2 as the first thing, because that is something we cannot escape. And then we're not in the scope of amount A, but amount B, of course, and that is more in a way traditional transfer pricing. And of course, there's also it is work in progress. We have the public consultation document out, which is in a way not very many people, I would say, were pleased about it, and there was a lot of responses to the public consultation document. And what we actually I'm also a part of business at OECD Tax Committee, and when we put a lengthy response to it, and we kind of responded to the fact that at the public consultation document, it's a mandatory approach. If you're in scope, you have to apply it. And the scope is narrow. We have distributors that have operating assets. They distribute multiple countries. There is no way that our distributors would be in scope of amount B unless the scope is bigger. So what we put forward at the BIAC is as actually that it should be a safe harbor, that if you have a low risk distributor, you're welcome to apply it. And I mean, the scope limitations that are listed in the document, it's in a way, basically, it's only wholesale distributors. It's so many restrictive ratios in the text that it's actually difficult to fall in scope. And of course, when you look at the text, I mean, the fair question they ask, if it actually is a simplification or just a compliance burden. If you need to calculate all those ratios, I mean, thinking about the current situation, we deal in another transaction, it's a low risk distributor. We have benchmark prepared, we take the median. And if you want to apply amount B, okay, there's a delineation transaction as a low risk distributor, then you go into amount B calculations, whether or not you're in. And if you're in, you still have to go to the benchmark matrix to find your place within that matrix. I mean, wasn't the idea of amount B to be simple approach for developing countries? And I mean, the fair question is to ask, where is the simplification? And then a third thing is that actually this is a growing trend from European perspective, at least, is the sustainability reporting, ESG and tax. Tax is part of ESG, the G part of it. And there is a reporting framework, this GRI 207 standard. It's applied by many European countries or companies already. And then of course, that is kind of standardized. You have requirements in the GRI that you actually have to explain your approach to tax, your tax control framework. You have to publish your CBCR data. That's it. If you apply the standard, you have to do that. And then kind of the other option is what companies are also doing is a tax footprint, total tax footprint, tax contribution reporting. And that is kind of the narrative. You can decide yourself what's the content of the report and what's the source of the report. And quite often, what comes to transsurprising is that actually if you publish data that you actually have a CBCR-based data that you can tell the amount of taxes paid in a country, well, that might have to actually tell the narrative. You might have no taxes paid because of tax loss carry forwards, etc. And that is, and then when it comes to sustainability, I think there is another TP aspect as well, is that as sustainability as a function. When you look at the value chain, it's actually sustainability creating value, because we're claiming to be the global leader in sustainable stainless steel. When we look at our value chain, we say that we provide low carbon stainless steel to decarbonize our customers' value chain. So we look at sustainability as a value creating function. And then we have to do the basic exercise that who's doing the function, who's taking the decisions, who's taking the risk. So that is actually what I see. That is also, in a way, a new trend, that you look sustainability as a value creating function. And I think those were for the three topics that came into my mind out of the given topic.
Thank you so much, Senna. Senna Jalinoye, Global Head of Transfer Pricing at Outokumpu Group. And our next and final panelist is Jaime Linaza, Head of Transfer Pricing at Iberdrola. You have the floor.
Okay, so, well, just like a quick overview, as Sana did, that I think it was a great idea about Iberdrola. Iberdrola is the leading European electricity company and is the second one in the world in terms of market capitalization. So our figures are mostly, well, we are subject to Pillar 1 and Pillar 2. We have 45 billion of sales, more or less, and more than a 10% of profit, EBT. So we are subject to all of the BEPS and OECD trends and proposals. So actually yesterday, I'm going to say something because yesterday, talking with Sana and also hearing all your presentations, I had in mind a different kind of presentation that it was more aligned with Sana, but in order to say different things and make it more useful for you, looking at you that you are like service providers, I have changed a little bit my speech, so maybe it's not as aligned as it should be with the presentation. Okay, so if we can go to the, oh, sorry, I have it. Okay, so what I want to give you is just like an insight overview or about the concerns of multinational entities in terms of tax in general, and also transfer pricing particularities. So first of all, and for a higher level of review and supervision, there is the board of directors. So the board of directors right now, their main concerns about tax or transfer pricing is a reputational component, right? So transfer pricing was, as Adrian was saying this morning, that we were like very sophisticated professionals. Nobody knew anything about transfer pricing. And nowadays there are more and more competitors and more people knowing about transfer pricing. At the beginning, because of that sophistication, all the multinational entities or different companies, corporations were taking like different approach, more sophisticated, trying to look into their transfer pricing, how to optimize, sorry, from a tax perspective, their value chain and their structures and transactions. But nowadays, I will say since BEPS, since 2015, the main concern of the corporations is the reputation. So nobody wants to have like a reputation problem, something in the press about transfer pricing, that you are shifting profits, that you are not contributing to your country or something like that. So that is one of the main things that we have in mind in our tax team in Iberdrola, that is compliance, compliance, and compliance, and just try to respect, strictly comply with the regulations. And that it's linked or associated with what Sana was saying about ESG, our social contribution as a company. So in tax and transfer pricing, I mean, our main contribution to the ESG factors is the total tax contribution that we actually are publishing in Iberdrola throughout all of our annual reports. At least in Spain, and we know that in the European Union, in many countries, is happening the same. We do have multinational corporations bad pressed about how we use taxes, or that we do not pay enough taxes in our local countries, and that is not true at all. I mean, and that's the reason that we are doing the TTC, the total tax contribution. We publish that in an annual reports, in the non-financial statement reports, and in the tax transparency reports that we publish to our shareholders. Just so you have like a general view, Iberdrola is paying like a 47% in taxes, in different kind of taxes, not only corporate tax, but in all the taxes, energy taxes, local taxes, all these kind of different taxes that apply to us. We are paying like a 47% out of our EBT. So, I mean, that's a lot. So the problem is that when you publish your financial statements, they just take, the number, they divide it by the EBT, and they say that is your contribution. And we all know that because of different regulation, that is not true. So then flowing down from board of directors to just like the global tax team in Iberdrola, our principles are these ones, that they are the legality, is compliance, as I was saying, responsibility, management of risk, cooperation with tax authorities, and transparency. That are our four main pillars when we do things in Iberdrola. So in terms of compliance, now we are in the era of data. Okay, so what we have seen in the corporations, and it's a really problem for us, is very challenging, is that we are investing, or let's say spending a lot of time trying to identify the data instead of managing it, right? So that is a very serious problem because, for example, if you want to know how many legal entities the Iberdrola Group has on a worldwide basis, you can ask two different people the same question within the organization, and you're going to receive different answers. So if you ask how many legal entities do we have to the compliance team, they're going to say something. Control team, he's going to give you another response. And if you go to consolidation team for financial statement purposes, they do have another number of that kind of for the same question. So that's the reason that what we're trying to do is just to internally define processes about how we should interact between different departments, and especially who is the owner of the data. And that is very important, as Sana was saying, and Chris as well, that we now have like an international framework with different regulations. You're publishing a lot of information to the market. You are providing information to different organisms around the world. So that is a very important thing in a multinational group, to know who is the owner of the data, who has to provide this, and in which way, right? So then we are working on that in the internal processes about the data, and then so we can spend more time on managing them, and just is when technology takes place and get into our systems. About the cooperation and transparency, just to point out that transparency in multinational groups, we have our tax transparency report that we are publishing every single year. We have the CVCR, we have the non-financial statement reports, both of them, one to third parties, and the other that we have for tax purposes as well. So, I mean, we are publishing a lot of information. Actually, our CVCR report, we do it in February of X+1 year. So we just released our CVCR report to the market in February of 2022. So, I mean, we are trying to be, in a contemporaneous way for everything, for transparency as well. And in terms of cooperation, the same. I mean, we are having like APAs, a lot of APAs. That is a way of cooperation with tax authorities. We are now, for example, participating in the ICAP program from the OECD. So we are trying to cooperate with tax authorities in order to be as good taxpayers as possible, and also DAC 6 and everything. So now we are subject to a lot of pressure in terms of transparency, requirements, compliance, and everything. And the conclusion of this is, for what? I mean, what do we get in return for all of this work, for all of this compliance, for all of this? So is there any tax certainty position, like law security? You are asking as a good taxpayer that they are not mandatory, but we are doing our best. Are we getting something in return? If you are coming in a tax audit, are we going to avoid any penalty? Are we going to have anything in return? So the answer for us, to be honest, nowadays is not. Probably we are not getting anything in return. I was saying, and I don't know if it's a coincidence or not, but we started the ICAP program with the OECD, and in some of the countries that we are in the scope, 2 months later, we have a tax audit open. So, I mean, I'm not sure if it's a coincidence or not, but it's the first time that we have a tax audit in those countries. So that means that, we are a little bit concerned about how to get that certainty that the board of the directors are requesting for us, because they want to know that. They want to know that we are in a good position, that we are complying with everything, and we are not going to have problems around the world. And the answer is difficult to say. So, well, that is more or less our pillars. And then, so just to, I was hearing yesterday my Brazilian colleague about the pillar 2 and how the Brazilian regulations were. And that's true, like simple, because you have your safe harbors and it's simple to apply. But the problem is when you are in a global corporation and you need to define global transfer pricing policies, because it's the only way to secure your position against different tax administrations. You need to apply it consistently. We do have like a very large subsidiary in Brazil that is a listed company, and we are having a lot of problems, not in Brazil, but with other countries that they are asking, why do you have this with Brazil and not with me? Can you compare me the results if we go from this approach in comparison to the approach that you're applying to me? So as long as we have like different regulations, different requirements from different tax administrations, we are always in a position of risk. And it's very difficult to manage from a global tax perspective, global tax policies, because when we are trying to define those policies, we need to bear in mind all the particularities of different countries. Specifically, in particular in Brazil, for example, we do have the typical global centralization of corporate services that they are here in Spain. In the parent company, we do have all centralized, and we just follow the OECD procedure of indirect allocation based on some key key indicators like human resources, number of people, number of employees, IT, number of users of the software, and those kind of that they are actually accepted by the OECD, because they know that it's almost impossible in a global multinational group to manage otherwise, because you cannot go to every single detail of every single cost. So we are following that around the world, and that is the problem that we have with Brazil, for example, because we have non-deductibility of the cost, of part of the cost, because we are not following their rules. But we cannot do anything else, because we do have another 45 countries to take care and to have a consistent policy. So that's the reason that diversity in regulations and diversity of jurisdictions makes us like in a riskier position and a more sensitive position. And as also, well, as Sana was, or Krishna as well, indicating, right now in terms of compliance, we are having like excessive TP requirements. For example, I'm not sure if you know about Portugal. Portugal, I think it was last year, they started to require global information, even if they are a subsidiary, a small subsidiary. If you are located in Portugal, they want to include in the local file all the global information about global intercompany transactions, the CDCR, and all the information around the world of your group. That doesn't make any sense, because it's not the parent company jurisdiction. It's just a subsidiary. There is a small subsidiary. And to be honest, in our case, in Iberdrola, we do have in the United States and Brazil, they are listed companies. So what is the protection for the minority shareholders? I mean, we're sharing information in Portugal while we do have like minority shareholders in the US. Is that even, I mean, in compliance with the US regulations? I'm not sure of the rights of the shareholders. So, well, at least in Portugal, what we have heard from our external advisors is that nobody's complying with that. They are going to court with these regulations. And they are just stating in the local files that we will provide it upon request or something like that. But we are not, at least in our case, we are not including it yet. And the same about Poland. I put here the example of Poland, but there are other countries as well where now transfer pricing is being linked to criminal law. And that is, I mean, I don't like to say that it's a nonsense, but at least it's a kind of threat to the companies. Like, okay, your administrator is going to be subject to criminal law if you do not comply with the submission on time of the local file. I mean, I would say it's like an exaggerated measure, but it's a problem. The thing about this is a concern within an organization when you have a criminal law applying to the administrators of these companies. In Poland, there are, for example, in our case, there are small companies. The administrators are Spanish guys who are not earning more money for this. They are not doing a lot of value functions or anything. They are just as administrators of one renewable plan. And then you have to tell them that because of transfer pricing things, they are going to be subject to criminal law. And you need to submit to the Polish tax authorities a repentance letter saying, okay, I am responsible of this, I have this, I have done this is the reasons why, and this is just if you mislead that information in the local file or if you forgot to include a transaction in the local file. Of course, I will assume that that is just the theory and in practice is not going to be applied. Or let's hope, but okay, so, well, more or less it was, I just wanted to give you like a glimpse of our main concerns internally in terms of how global tax function and transfer pricing function is viewed within a global organization and also from the top of, from board of directors. That's all.
Thank you so much, Jaime. Jaime Linesa, Head of Transfer Pricing at Iberdrola. At this moment, dear panelists, thank you so much for your presentations. We will open a Q&A for our panelists in order for our public to make any comments or any questions that you have for our panelists. So being open, there's any question or comment that you would like to address to our panelists?
So you mentioned about APAs that, I mean, you have entered into APA with competent authorities. So can you please share your experience in terms of what challenges you faced? Were there any differences between the competent authority and the management? And if yes, then how did you, resolve those differences?
Yeah, so that's a good question because what we usually do is since the main transactions or let's say the with more risk transactions are based from Spain because it's the parent company through to all the rest of the jurisdictions. We usually start with the Spanish tax authorities that we actually have a very good relation with them and just propose like for a specific transaction an APA. And to be honest, I guess it's very similar in all the countries because what we have is if it's kind of interesting transaction, it's very easy to reach a conclusion and an agreement with them. If not, always something happened that they leave it there, and it's very challenging for us sometimes to get an APA approved. But our strategy is just we start in Spain and then we try to bilateralize that APA, and that is easier, for example, to do it. In the Netherlands that we had, for example, the financing entity that is issuing all the bonds in the market in the Iberdrola group, we used to have like the typical APA in Netherlands for the equity at risk and everything. And now since the new regulations, we cannot do that. We are actually trying to let's hope if we can start in Spain and then go to the Netherlands. And in terms of teams, well, they are, I would say, at least in Spain, that is where I not know the most. They are more sophisticated usually in terms of transfer pricing. We do have like the international tax office, national office, and they are usually open-minded and they are always hear you about which are your concerns or which is your approach. And we usually receive like informal input about you should file this APA or not. I mean, so we don't waste time if we see that it's not going to end well, but at least we usually have these informal meetings. And in comparison to the tax audit teams, I mean, depending, I was talking with some of you at lunch, depending on the country where we are like a large subsidiary, in those countries like Brazil, US, etc. Usually the tax audit that comes to us is very sophisticated and it's a really good, well-known tax audit team. But in those countries where we are not that large, usually they do not know anything about transfer pricing and they just want to make an adjustment, whatever. So it's like, you decide where, but I'm going to make an adjustment. I mean, different realities.
Yeah, can I agree that it's the main transactions is it's good to cover with an APA, and that the smaller the transaction is the more in a way I'm kind of inclined not to apply for an APA because of course APA comes with a huge cost. You have to kind of make the cost benefit analysis because sometimes even the fee is quite extensive, and then of course it's the more further the country is to your own local knowledge or more exotic country, then of course the advisory fees are also one option in a way, adding to the cost.
Thank you. Any other question from our public?
Thank you for your presentation. Very interesting to get the more inside the company view. My question was really with regards to the local files. So on the one hand, you got the master file, the local files, and what I've been seeing so far up to now have been very high level. These are this is the parent company. This is how we characterize the other entities, and then identify ranges or splits depending on the method. But they don't go into the details of the actual financials. Do you think Pillar 2 is now going to force you to start submitting this financial information that has probably not been provided in the country by country reporting elements? How is that going to impact your company?
Well, that's a good question. And actually, as I was saying with Portugal, it seems that some of the countries, they want you to have that information, right? So, I mean, we are starting working on that, on providing more and more information, financial information regarding in the local files, the specific jurisdiction. So actually with our external advisors, we do have right now first section about financials, situation, activity, which are the main drivers of those activity or what is impacting our profitability, for example, in that activity. And we added for some jurisdiction, not all of them, we added like an additional section regarding the taxes and how, for example, in the US that we are in the renewables industry, and in the US there are like very large tax incentives for renewables entities, which leads you to have an ETR of 0 point something. So when you see that in the CVCR, I mean, of course, someone will say, okay, what is this? I mean, what your ETR? And that is what it goes to the press, actually. They just take that and they say, okay, Iberdrola is not paying taxes in the US. What is doing with this? What is the profit shifting? Where are the profits? And because they are a large corporation, and everything has an explanation. So we are starting to include in this in some minor comments about this in our local files, and also the tax transparency report. But in terms of when the Pillar 2 comes into effect, I mean, I guess to be honest, for us, we already have all the analysis, the preliminary analysis, and it's not going to impact at all. So we are going to have to go through all these compliance burden and adapt all the systems and everything. But our conclusion is we are not going to have any impact unless something in the US happens with these tax incentives that they do not qualify for Pillar 2 purposes. But yeah, I mean, our main concern right now is with the board of directors, to be honest, this year, and the tax auditors. Because what we're seeing is, okay, we are going to implement the Pillar 2 for next year, but for for external audit purposes, do we need to include something in the financial statements right now? So that is what the external audit is requesting from us, and we are trying to quantify how much could be if any, the impact.
I can also kind of express that because basically what we do in a local file nowadays already, that we provide a full economic analysis with segmented figures. So that's gonna stay there. But of course, in a way that we only do it for the country. We're not kind of willing to put any other country's information in a local file. So basically, that is something that has to go via exchange of information if the country wants to have something from another country. And in a way, and I can echo you as with the pillar two, that it's not gonna end up in a top-up tax or anywhere. It's just a huge compliance exercise. It is not bringing any taxes anywhere. But we kind of have implications as well, that we even operate only in 2 countries where the tax rate has been below 15%. The other one just implemented a 15% tax rate, and the other one has a 9%. So I don't think there's any effect. And then even if there would be countries with a lower tax rate, they would introduce a domestic top-up tax rate. So it is for compliance, and the sad thing is that we have no any other use for the data. We're collecting for the pillar two.
And actually, I was speaking also before this morning with some of you about, okay, it makes sense, pillar two. It's a good measure, but probably this measure is focused or is targeting to all the jurisdiction to take action, right? And all these jurisdiction, okay, go up like Ireland to a 15% of your corporate tax rate, and that's okay. And that's, I guess, the purpose. And we have achieved it, but since that is the purpose, why we have to go through all of this compliance burden to reach a conclusion that is the same? So what we request from multinational entities, I guess, is the safe harbors that they just released. They are okay, but we are looking forward to see which are going to be the permanent safe harbors that are still to be released, because we want to have, like, if you have substance, you have a qualified corporate tax rate in that jurisdiction, and you have 3 or 4 conditions, just forget about the pillar two, and don't start doing all this process for all your entities.
Thank you. Any other question from the public? Any final remarks from our panelists? Well, seeing none, thank you very much for our panelists for this panel session. Thank you for the public for this session. We will entertain in this moment a coffee break for 20 minutes, and then we will come back in order to have our last session of this annual global conference, where we will have a panel of discussion with a topic related to tax risk and controversy for companies operating in Africa and Middle East. So we hope to see you in the next session. Thank you very much.
I would correct you. I would correct you. I will.
Right now we're having a quick yeah, and if you don't mind. Have others done it? Well, we're already so much into it. Just We're talking about transfer pricing seriously. This is not that serious. And it's not difficult as well.
Quem levar vai. E aí você vê
Más hacia. Giras, vas para allá. Tú aquí. Para atrás. Y más girado hacia acá. Porque apenas se veía ese corte. Sí, sí, más o menos sí, pero que... A ver, acércate un pelín. No, ahí está guay. Ya está. Vale. Vamos a cambiarla. Es que ponen la diapo esa de...
La especificación o en la cláusula del decreto. Si hubiera
How long is the video? Good day, man. Yeah.
Well, I have them on my phone. Yeah. I took the photos.
Yeah.
Okay, so first one, introduction.
Yeah.
Okay,
One
eye
moment.
centered.
One moment. Un poquito para acá.
To the right. Okay.
Right. Perfect. Un pasito para... Un poquito menos. Ahí.
Okay. We're good.
Maquillaje.
Done. Okay. This is great. Yeah. We don't.
3, 2, 1. Hello, my name is Andre Bergeron. I'm an economist with Galling WLG. I've been with Galling WLG for 2 years, providing transfer pricing advice to multinationals with operations in Canada, but also in the United States, Japan, and in Europe.
Okay. Ahora la pregunta. And now the question.
Yeah. Or did you want me to go like
Yeah, if you want.
through all of them?
Yeah, fine.
So what motivated our firm to join PPI Partners International is really to develop these linkages with similar firms and service providers in other countries where we could serve our clients and create these linkages with the other countries. So, for example, we've made some great linkages here at this conference today with many representatives in Latin America and in Europe, and that was really the objective of our involvement with Pride Partners International.
Okay. Another one?
The next one.
Okay. As a transfer pricing professional in a major law firm in Canada, we offer something very different, I think, to the other members of PPI, from the perspective that we are involved, our firm is involved in mergers and acquisitions, and many companies coming into Canada. So what we do is we are encouraging our clients to participate in that. This one, that one. Okay. Yeah. Okay. So our firm provides value-added service with PPI because we're in part of a very large law firm in Canada. Galling WLG has been around for over 100 years, and we service multiple multinationals, either coming into Canada or exiting Canada, or setting up subsidiaries abroad. So we think we can leverage that and provide Pride Partners International members with a value offering and having an inside scoop as to what is going on, both with Canadian companies leaving to set up shop in other countries, but also with companies coming into Canada. So the elements of PPI that I think are fantastic are the monthly webinars where we get to exchange with other practitioners in different countries and share ideas as to how various tax legislation and OECD measures are impacting those jurisdictions. So for example, I presented in September on various COVID effects, other presentations in intergroup services in Africa and Europe have definitely helped give us a global understanding as to what's going on from a transfer pricing perspective. It also creates these links with other practitioners where when sometimes you think that you're the only one working in your small shop in Canada, then you've got these networks that you can leverage to develop stronger ties and better service your clients. Okay. The last one, or so in one sentence, I would say that Pride Partners International is definitely a go-to and is on the way up with regards to exposure, as more and more transfer pricing professionals are looking for these linkages with other countries. I think Pride Partners International is really a one-stop shop, being able to identify practitioners and service providers in other jurisdictions that they really get ahead. So I definitely encourage all of you to look into Pride Partners International and in particular to so that we can work together on future projects. That was a long sentence.
Yeah.
Kind of incorporated the last two questions there. So.
Hopefully it'll be. ¿Queda una o no? ¿Estás sorda?
Yeah, well, I think so. I don't think. Yeah, I think that's good for now. Answered most of them. Okay, unless you wanted me to take another one, try another one. Were they okay or?
¿Cómo?
No,
I think it's okay, no? Yeah.
Okay. All right, that's cool.
For the time.
You wanna? Okay. Oh, okay. Hey, Guru. It's like a clown pulling the handkerchief out, right?
Yeah.
There you go. Did you want me to find you another volunteer to do this?
Maybe we should.
Has Karen's done it?
Totally what you described. So Matthew, thank you very much for your care. All the best.
Dear members and representatives, in 5 to 10 minutes, we will begin with the last session and with the last panel of discussion.
Quería bajarlo de altura porque al final. Por la derecha. Ahí. A ver. O sea, un pasito para atrás. No, un pasito para atrás. Ahí le cae la luz. Okay. When you want, 3, 2, 1.
Hi everybody, I'm Cedric Mayo from CW Portfolio. So I'm living in Casablanca and I'm transfer pricing expert. So we have four business. It's about transfer pricing restructuring. We assist countries in their transfer pricing issues in the North African region, the West African and Central African region, basically French-speaking African countries. We assist our clients in the case of tax audits about transfer pricing, and we take in charge of all the transfer pricing companies. What I found interesting in joining White Partners International is basically the ability to share some experience with other members of the network, to ask for a second opinion on a specific question, for example, and the capacity to access to databases quite easily.
Okay, right. Other question or?
You want
Yeah, okay. Thank you.
Thank you so much.
In that ranking, the number two is our president. But in my case,
Thank you. Vale. Voy a preguntarle si hay una.
how does succession work? Is there any succession? Okay. I'll be right back.
Pero no tengo que leer la pregunta, nada más la.
Hi, dear members. We are finishing some of the interviews, and we will begin in 5 minutes our presentations of the last panel.
Finalizamos la.
Ya estoy entrenado. ¿Lo saco? Si quieres pasamos por encima y te voy a Yo creo que ahí.
Vale, un poquito para atrás. Un poquito donde estás tú, Robert. Sí, para allá. Vale, más para allá. No, pero no te lo lleves tan para atrás. Ahí, ahí. Perfecto, ahí. Vale, pues 3, 2, 1.
One of the main benefits that we found as a firm in joining PPI network was the opportunity to get to know how other professionals manage transfer pricing services and transfer pricing compliance in other regions of the world. So as a Latin America practitioner, it is always good and very useful to hear from African, from European, from American practitioners. So that is definitely help us expand our scope and our understanding of the transfer pricing dynamics all over the world.
Okay, and now you can tell us your name, your
Okay. Cuando quiera. My name is Francisco, Transfer Pricing Manager at FA Consulting Group.
Vale, genial. Pues muchas gracias.
Sí, dale, dale.
Voy a quitar la cámara que ya queda.
Ya está.
Con mucho gusto.
Ladies and gentlemen, 1 minute to start the last session.
No, igual. Aquí hay dos. Y allá hay dos. ¿De quién es?
No lo sé.
Ni idea.
And also aquí.
Ah, debe ser de el tiene.
Ah, ok. Esto debe ser de él entonces.
Sí. ¿Te sientas dos aquí entonces?
No, tres y yo. O sea, cuatro, pero no cuatro personas. Sí. Vamos a ese darle play a la siguiente sesión. No. Para ir a Yes, my wife.
Okay. Dear members and representatives of different international organizations and enterprise, we shall begin with the last session of this 2023 Annual Global Conference of Pride Partners International. Please be seated. Thank you. For our last session, we will have a panel of discussion that will have for central topic section, as well as the correspondent responsible for updating the IBFD transfer pricing documentation tables on Gabon, Ivory Coast, and Tunisia. There is Cedric. Please join us on the panel. Thank you very much. Our second panelist, Rubina Dina. She is partner at Global Tax Service. Rubina is a partner at the award-winning boutique international firm Global Tax Service based in the United Arab Emirates. And she is the founder of GTS Africa with its office in Mauritius. She covers international tax and transfer pricing in Africa and the Middle East regions. With a finance background and a specialist in international taxation and transfer pricing, Rubina has taxation experience from both industry and consultancy across 4 continents for 20 years. She has extensive experience and understanding taxation, legislations, and transfer pricing regulations across a wide selection of countries, and their practical implications and the formulation of compliance requirements. Over the past 8 years in her consultancy role, she has worked extensively across a range of clients from different industries in Africa and the Middle East on transfer pricing, advisory, and compliance projects. She has also helped in building capacity in transfer pricing at the Kenyan Revenue Authority. Previous to her time in consultancy, she worked for multinationals in Australia and the United Kingdom for 12 years, where she was responsible for finance and tax. Rubina is a fellow member of the Institute of Chartered Accountants in England and Wales, and holds an advanced diploma in international tax and transfer pricing. Rubina, you're welcome to join us on the panel. Rubina will also have 2 different presentations. First, she will present the overall on Africa, and at the last one will be about Middle East. And our last panelist is Antonio Pina. He is partner at transfer pricing specialist in Grace. Antonio holds a degree in economics and business administration from the University of Zaragoza, a master in business tax consultancy from the School of Applied Finance, and an executive master of business administration from ESADE. He began his professional career as a tax advisor for multinational groups at Longwell PricewaterhouseCoopers, where he became a senior associate, and has specialized in transfer pricing, working as senior manager at Ernst & Young, Spain, and Deloitte, Ireland. He has worked more than 18 years of experience in advising on international structures and transfer pricing policies to leading Spanish and foreign multinational companies in various sectors, such as energy, telecommunications, pharmaceuticals, and finance. In the course of his professional career, he has participated in the design of transfer pricing policies for Spanish groups with operations abroad, coordination of global transfer pricing documentation projects, defense of valuations of related party transactions before the tax authorities and courts, as well as the negotiation of prior valuation agreements and amicable procedures with the tax authorities. He is currently a partner at Transfer Pricing Specialist. You're welcome to join us, Antonio. Thank you very much. We will remember each of our panelists will have 10 minutes for their presentation, and at the end we will open a space for Q&A. So at this moment, Cedric, you have the floor.
How it works? Like that. I think I switch off. Mhm. This one? No, it doesn't work.
There you
Okay.
go.
Okay, thanks very much. Hi, everybody. So maybe we could begin with what we could call a trend in the French-speaking part of Africa. And if I may speak of a trend in terms of transfer pricing, probably we should first of all speak about the modernization of transfer pricing legislation with the implementation of BEPS Action 13 guidelines in different internal laws. So in the slide, you will see the main jurisdiction of that region, and then the date of implementation of master file and local file requirements in those countries. So you could see it's very something recent because it ranges from 2018 to this year with the implementation of master file and local file obligation in important jurisdiction, Ivory Coast and Cameroon. Okay, so transfer pricing in that part of the world is very something recent, but very fashionable. You will see just after. So some background about the region. In the north, you have the Maghreb, North Africa region, with Tunisia, Algeria, and Morocco and Mauritania. In the south, it's Mauritania. So what we could say about these countries, first of all, Morocco, which is probably the most developed country in the area. So Morocco is an interesting country because it's really the door, the bridge from Europe to that part of Africa. You have a lot of double tax treaty in force in Morocco with both Europe, France, of course, Germany, UK, Switzerland, Spain, with North America, the US, of course. Interesting facts, Morocco is the first country to have recognized the USA as an independent country at the end of the 18th century. So double tax treaty in force with the US, and many double tax treaties in force with other African countries, which is quite unique in the region. So a bridge from Europe countries to African countries, good infrastructure, famous food, semi-finalist of the last World Cup. So very, very interesting and beautiful countries. The neighbor Algeria, which is the biggest country in the whole continent, oil and gas resources. Of course, speak both French and Arabic. They are Muslim countries. So in green, you have West African countries. So West Africa with important jurisdiction, Ivory Coast, Senegal, Ghana, Nigeria, Togo, Benin, Mali, Burkina Faso. So an important mining industries in this country, especially in Senegal, in Mali, in Burkina Faso. Very young population, young and dynamic population. The north of these countries are Muslim, and in the south they are Catholic. Okay, and then in yellow, Central Africa with Cameroon, with Gabon. So in terms of industry, you have oil industry in Gabon, and for the rest, it's essentially agricultural industry. Okay, but it's the less developed countries in the whole continent. That's for the background. Okay, so in terms of transfer pricing, the only common point is that, as I said, the transfer pricing is something recent, and tax authorities are rather unskilled to date, okay? Which makes the transfer pricing activity interesting, of course, but very tricky and dangerous for your clients, okay? So let's illustrate that point with 3 different real case study, one in Morocco, one in Ivory Coast, and one in Cameroon to illustrate that fact. So if you make a cartography of the Moroccan economy, you have, of course, the informal economy, like in each African countries. So informal economies, of course, by essence, out of the scope of tax. Then you have the formal economy, which is the smallest part. And in the formal economy, 90% of the companies are SMEs. So they are insolvent, so not interesting for the tax administration. At the end of the day, if you want to collect money, you only have the multinational enterprise and the subsidiaries of foreign investors. Okay, so they are really the target to collect money, and that makes sense. Okay, so basically, the Moroccan tax administration is very aggressive in terms of transfer pricing. They are making huge and quite automatic reassessment in transfer pricing as soon as there is a tax audit on a subsidiary of a multinational enterprise. So huge reassessment with basically 2 different strategy, 2 different means. Of course, deductibility rejection of expense, especially for management fees. If a local company pay management fees, 80% the tax administration will say, okay, management fees aren't tax deductible. Why? Because you did not bring the proof of the effectivity or substance of the services. Quite easy argument, because of course it's quite difficult to prove the substance of a service which has been rendered 4 years ago. And if it's not about the effectiveness, it will be about the usefulness. Okay. It's a double service with what is rendered locally, or it's a shareholder cost, or some argument like that. About the pricing construction, they have a kind of internal doctrine, which consists in saying that every management fees amount which is in excess of 2% of the turnover is not tax deductible. There is nothing in the law, nothing in the tax doctrine, but it's very administrative doctrine. So quite easy to fight with them because there is nothing in the law. Okay, and the second strategy, the most dangerous one, is about the application of the TNMM. But so they don't call it TNMM, but in fact, it's the TNMM because they are using secret comparables. Why are they using secret comparables? Because of the way the internal law is drafted. Let's have a look at the transfer pricing article in the General Tax Code. For the purpose of adjustments, the profit indirectly transferred, as indicated above, are determined by comparison with those of similar companies. This is the original text in France, but they had something, or by direct assessment on the basis of information available to the administration. Which means
In case of a tax audit, they will say, okay, you have a X% margin. I'm the tax administration, I have information, and in your sector, you should earn a 20% or 35% margin. Okay? So it's quite strange from an intellectual point of view, because if you ask for sources, for data, they will say, no, impossible. I am submitted to secret, to professional secret. So I can't give you any data, which is quite strange because companies have the obligation to publish their financial statements. So why is it a secret? At least it's not prohibited by professional secret to say, okay, we selected companies, independent companies in that kind of industry. We have 7 comparables company, and the entire quartile range goes from X to Y%. That would be okay. That could be a discussion. In fact, it's not even secret comparables. There is no comparable at all. They are just reasoning with a spot rate, and that's quite dangerous. Okay, an illustration with Nestlé, which is the big case in Morocco at summer 2021. In the local and specific in the media, we heard that there was a transfer pricing reassessment for Nestlé Maroc of 1 billion dirhams. 1 billion dirhams is the equivalent of a little bit more than $100 million or euro, which is quite huge for Morocco. Okay, and why this reassessment? Quite simple to understand, actually. It was just before COVID-19. The government needs money, obviously. So Nestlé is a good target. Why? Swiss group, which means money. Foreign multinational, leader in the agro-food industry, and rather a winning industry regarding the COVID-19. So they have money, so they are able to pay. Okay, so basically how the reassessment was built, typically using secret comparables. So what is the net, the operating margin of the local wholesaler in Morocco? 5%, all right. I'm the tax administration. I know in your sector it should be 15%. 10 points gap. You for financial exercise audited, plus penalties and late interest. So if you have a turnover of 2 billion dirhams a year, it will result on 1 billion dirhams reassessment. Okay, so why this mechanism is implemented in Morocco? It's because 90% of tax audits are sold by an amicable transaction. You know, we have a joke in Morocco. For any company, there are 3 versions of financial statements. One for the bank, the good one for the tax authorities, the bad one, and the real one for the CEO, in order him to be able to know the reality of the company. So if you have that joke in mind, you understand that it's a negotiation culture, because nobody in the company wants the tax inspector to investigate the accounts. So 90% of tax audits are sold by an amicable transaction. Okay, so what the tax inspector has in mind is that if he say, okay, it's 1 billion dirhams, probably at the end of the day we'll collect 300 or 400 million, and it's okay. But what we have to do as transfer pricing council, is it okay to negotiate, or is it not okay? I personally think it shouldn't be okay, of course. And is it possible to go to court with chances of success? The answer is yes. Okay? Two facts to illustrate that trend. First of all, a recent publication of a report from the local tax administration. We have seen that there is actually currently 6 MAP procedure or MAP pending in transfer pricing case. So it's quite a recent fact which illustrate the fact companies don't want to negotiate anymore. And second fact, a recent publication from the OECD, which have shown that in terms of tax issues, when you go to court, only 27% of decisions are made in favor of the tax administration, which means 73% are in favor of taxpayer. So if you think your transfer pricing policy is okay, you have a benchmarking study justifying the arm's length profitability of, for example, 5% in the case of Nestle, go to court. Okay. In West Africa, Ivory Coast is an interesting case because in West Africa, there is really the culture of capacity building with OECD programs, for example, lots of work performed by ATAF, maybe you know ATAF Administration, Association of Tax Administration Forum, yes. And of course, the work performed by Tax Inspectors Without Borders. I'm sure you know that organization. And I had a case, so in their last report, they say in Ivory Coast, tax administration collected an additional 12 million USD in just 4 different transfer pricing cases. I was in defense on one of these 4 cases. And what was interesting is that for the first time, the tax administration produced a benchmarking studies in the international standards, meaning in accordance with guidelines of Chapter 3 of OECD principles. So, so we have we had a debate, a real technical debate in Abidjan about their comparables company and ours. And it was quite interesting and quite an interesting fact about what is happening in the area. Another trend in West Africa is the fact the tax doctrine is quite good. In fact, for example, in Ivory Coast, you have circular notes about the tax deductibility of management fees, which of course is rather copy-paste of Chapter 7 of the OECD guidelines, but it's really important and really relevant to be able to have such kind of text in internal law because it's a balance and it's a good thing for the taxpayer to be sure that he could obtain the tax deductibility if he follows all that principle. Okay. Same thing in Benin. In Benin, you have a 45 pages document explaining what is the arm's length principle, how it works, and for example, something very interesting, which there is nothing else in other countries, the functioning of the interquartile range and how to adjust the profitability if you are not in the range. Okay, so really interesting, part of the continent which make many efforts. Last case, Cameroon case. So my, if I have an advice,
don't go to Cameroon. If you're an investor, really don't go to Cameroon. Why? First fact, it's not a transfer pricing issues, but you have a minimum CIT of 2.2% of your turnover, meaning it will be you will be lucky if you win money at the end of the fiscal years. Okay, because for example, in some industry with low margin, agro-food industry, for example, it's not really something current to have a net margin at the end of the year exceeding 2.2%. And it's clearly something that you can see in the CBCR. Just an example, I'm the counsel of a French group in the agro-food industry with an extensive presence in about 50 countries in the world, mainly in Africa, and 75% of the CIT paid around the world is paid in Cameroon. But still, Cameroon is aggressive in transfer pricing. Okay, and so if you have tax audits, their main method is to use the CUP method and to find some comparables. I'm not saying relevant comparables, I'm just saying comparables. And it's not a problem for them to compare something which is not comparable. Typically to compare DDP price with FOB price. Okay, no comparability adjustment at all. To compare premium quality with basic quality. But still, it's possible to have a discussion. It's possible to exchange and to win the case. It's something possible, but be able to make pedagogy and have technical skills in order to win the case. Last word about compliance in Cameroon, and that's why it's very a specific country. For example, you have a very early deadline for your annual TP form. As in many other countries in Africa, you have an annual TP form, declaration to file with the tax administration. The deadline is March 15th. That's why I wasn't able to be there this morning because I have lots of TP form to file. But March 15th, okay, it's very early. Again, for the master and local file obligation, if the administration requests and you don't have, you have to provide the TP documentation with a 15 days delay, which is very short. Normally, the period is 30 days in all the other country. And last but not least, the customs administration requires, it's very something new, requires any taxpayer which have 5% capital dependency with another company in the world to file a transfer pricing documentation with BEPS standards at the end of March. In my personal opinion, it is something that goes far beyond the prerogative of both the tax administration and the custom administration, of course. But it's the reality. I don't know if it could happen anywhere else in the world, but in Cameroon, it's the case. Okay, so again, don't go there. Thank you very much.
Thank you so much, Cedric. Cedric Mahel, Head of Transfer Pricing at CWA Morocco. Right now, we would like to welcome Ruby Nadina, Partner at Global Tax Services, for her first presentation.
Thank you. Can you all hear me? Yes, good, Good. So I'll be presenting on the Middle East. Before I do that, I would like to thank PPI for giving me this opportunity to do my two presentations. Thank you. So I will skip this. We've already got a good introduction. So what I'm going to be covering today is I'll be providing an overview of the landscape of transfer pricing across the region. I've selected 6 countries to have a look at. Then we are going to take you through some of the key aspects in Saudi Arabia, Qatar, Jordan, and the UAE. And then finally, we'll wrap up with a discussion of the risk and areas of controversy in the region. So, Saudi Arabia, Qatar, Jordan, Kuwait, Oman, and the UAE. So out of these 6 countries, Kuwait and Oman do not have transfer pricing regulations yet, but they do have a requirement for arm's length in their tax code. Saudi Arabia and Qatar implemented transfer pricing back in 2019. Jordan about 2 years ago, and United Arab Emirates from financial year of 2023. So some of the key aspects of transfer pricing in Saudi Arabia. Just a breeze through this. So in terms of the compliance requirement, so as Cedric was mentioning that in this part of the world, there is a transfer pricing disclosure form, which is normally filed in Saudi Arabia at the same time that the income tax return is being filed. Alongside with this, and this is something specific to Saudi Arabia, there need to be an affidavit. The affidavit is actually prepared and signed by a registered auditor in Saudi Arabia. And the affidavit is really a confirmation that the transfer pricing policy has been consistently applied. So there's the local file and the master file. And there is a threshold when it comes to which entity needs to prepare the local file and the master file. So entities with intra-group transactions of above 6 million riyal, which is equivalent to about 1.6 million USD, need to prepare the local file and the master file. And these 2 documentation, they are actually it's on request, and it's normally 30 days when requested by ZACA, which is the General Authority of Zakat, Tax and Custom. A bit of a mouthful. And in terms of, I just wanted to point out the definition of related party and control in this part of the region, because there are some elements which are quite different to other regions. So in determining control in Saudi Arabia, and we'll see in other countries as well, one need to consider the financial and commercial arrangement between parties. So what I'm saying is that, for instance, where there are 2 parties, one party has provided a substantial loan to the other party. These 2 parties can be deemed to be related. Or where one party is a major customer of the other party, these 2 parties can be deemed to be related. So it's not just the usual shareholding or an owner relationship.
Excuse me, I didn't understand you say where the arm's length value of intergroup transaction.
Hello.
Is this correct, or is for me is where the value of intergroup transaction is less? Because how do you guarantee that this value is an arm's length value?
Well, that's the yes, that's what the law says, the arm's length. So
I think it's a safe harbor. It's
yeah.
good. But
Yes,
if you
it
have
is.
to prove that
Yep,
this is
yeah,
arm's
absolutely,
length,
you're right.
yeah,
Yes.
that's
So you need to have already done your homework
Yeah.
on those transactions, and that, which is really a really good point that you're saying, because even though you do not have the documentation requirement, but still need your transactions need to be undertaken at arm's length, and you need to be still able to provide proof that your transactions have been undertaken at arm's length, even though they say that the laws say that you do not need to prepare documentation.
Because in the case of Brazil, Regina knows better than I, but if I'm not wrong, if you the intragroup transaction is less than 5% of your gross revenue, you have to do nothing. So
Yep.
that is just 5% of the gross revenue in
Yep.
group operation. But you don't have to prove that this
Yeah.
operation
Yes.
is
Yeah.
done
Yeah.
according to the arm's length.
Yeah, yeah. And this is something, I mean, that's a really good point that you are saying. And there are other countries as well, whether in the Middle East or Africa, where they say, well, there is actually a threshold for preparing and maintaining documentation, but yet you still need to undertake your transactions at arm's length. And if you're ever requested, you could still be requested for documentation from the tax authority. So in effect, I tend to advise clients to prepare their local file and the master file. Yeah, yeah. It's not really a safe harbor. It's a danger area. Qatar, in Qatar, there are two threshold which applies. One which is in relation to, again, that transfer pricing disclosure form that we've seen in Saudi Arabia. So the threshold here is for companies with a turnover asset which exceed 10 million USD. So they will need, these entities will need to prepare the disclosure form and file the disclosure form. And where multinationals have got a turnover asset greater than 50 million Qataris, they will need to prepare their local file, master file, and submit to the General Tax Authority. And something which is quite different in Qatar in terms of method that they use, there is the most appropriate method is not recognized in Qatar. It's the preferred method, and the preferred method is the CUP method. So if an entity is not going to be using the CUP method, they need to have prior approval from the General Tax Authority. Jordan, in Jordan as well, there is a threshold for preparing transfer pricing disclosure form and the local file and the master file, and it's around 700,000 USD. And in Jordan as well, you would note that the wide definition of control, which require the financial and commercial arrangement between parties. Now in the UAE, so in the UAE, regulations are coming into place from this year. Again, there will be that disclosure form, which will need to be filed with the income tax return, a local file and master file. There is no filing requirement yet. So it's all on request. And there are some interesting aspects to the regulations that we note. So one, the regulations apply to both domestic and international transactions, because in the UAE, there are free zones where they have tax exemptions. And the regulations apply to related parties and connected parties. So related parties, you'll be all familiar with related parties. What's the aspect which is different is related parties include natural person consideration. So your family, so kinship is or affiliation is going to be will have to be taken into consideration when determining related party. Connected person. So connected person to an entity would include the director of a company, the owner of a company, or an officer. So the reason why they've included this in the regulation is that there is no personal tax in the UAE. So a director of a company can give himself a really big bonus. So get that deduction, reduce the tax of the company, and that his personal tax, well, his personal income, there is no tax on the income. So that's why the arm's length requirement is going to apply on these transactions. So in terms of risk and areas of controversy, so on this slide, I'm looking at the different countries. So in Jordan, as the regulations, companies started submitting their report last year. So we're yet to see how things will evolve, what sort of queries will come up. In Kuwait, there is no transfer pricing regulation, but still we are seeing queries and challenges regarding related party transactions. And in Kuwait, where they make an assessment, they make a deemed profit margin calculation on the revenue. In Qatar, we are not aware of any major audit yet in the country. Saudi Arabia, KSA, this is the most active jurisdiction in terms of transfer pricing in the region. So there are many audits which are taking place. In the next slide, we're going to look at some of the transactions which are mostly queried. In Oman, we do see some expenses which are disallowed by the tax authority, and no surprises, there is no clarity as to why these expenses are disallowed. And the UAE, so it will be interesting to see what's going to happen, but it's my personal opinion that we are going to see quite an active landscape, just like KSA, because there always seems to be some competition between Saudi Arabia and UAE. So the type of audit areas that we can tend to see. So first, starting from the top, the functional recharacterization. So ZATCA tends to look at where companies are incurring losses or having low margins, and where these companies are full-fledged service provider, they tend to recharacterize them to being low service provider. So then associating a certain margin to these low service character. On the flip side as well, where they deem that there is not enough margin, which have been reflected by the company, they would say, well, you're actually a full-fledged service provider. So on the right, so where there are transactions with tax haven or low tax countries, for instance, in Oman, we see a lot of queries of transactions with the UAE and Bahrain. So we'll probably over the coming years see less queries with regards to the UAE, now that the UAE is going to be implementing taxes from this year. Financial transaction, actually from sort of COVID time and after COVID. So we start to see some queries and audit regarding financial transactions, especially where the creditworthiness of the borrowers in Saudi Arabia, that with creditworthiness, there has been some reduction in that creditworthiness. So then ZCA would want to recharacterize the loan to be an equity. Comparability analysis, and again, this is happens in Saudi Arabia. So we've seen instances where they reject the comparability data, and so on the basis that the functions of the independent party are different to the tested party, or that there is not enough information which have been provided. So what also we've noticed that when they do that, they do their comparability analysis, they tend to choose the median position, because in Saudi Arabia, it's the interquartile which is required as per their regulation. And lastly, but not least, is the quantum of intragroup transactions. So where the amount of the intragroup transactions tend to be significant compared to the value of transactions with non-related party, and then combine this scenario with a loss-making entity or low margin, this tend to attract the attention of the tax authority, and so then they will want to audit the entity. So that's it from my presentation. Any question, please? Sorry, I had to breeze through very quickly. Yeah, sure.
Question. In Latin America, many countries have this similar rule regarding related party transactions. Yes, the relationship is not only by shares, also by functions and activities. And in legislation such as in Argentina, Uruguay, we have directly the IRS list of assumptions of relationship. So when we hear you, it's really like a mirror of our legislation, even though countries are very far.
Yes, yes. And I suppose that in this part of the world, they have this arrangement, financial arrangement and commercial arrangement, because there are many family businesses which are connected. And so transactions then within those entities need to be under the scope of transfer pricing.
Yes, something just exclusivity, it's enough to be, it's enough to be related.
Yes, 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 that's right.
An important agreement with exclusivity is enough.
Yeah, yeah.
Rubina, thank you very much for this, and to you too, Cédric. One question actually for you, Rubina, but I've got another one for you, Cédric, and the two questions are not interconnected. Regarding KSA, you mentioned that the taxpayer is required to send a disclosure or a certificate or an affidavit. Does that mean that this is binding to the taxpayer? I'm asking because in certain situations, I've seen situations where the taxpayer communicated to the tax audits transfer pricing documentation that was prepared by an external consultant, whatever, not us, of course, neither any of you.
Not us as well.
Sure, Claire. And in this documentation, there were some mistakes. And eventually, we could say to the tax inspector auditing the company that, well, look, Mr. Tax Inspector, be a bit flexible and open-minded. This is not something prepared by a taxpayer, so we can't pretend we are fully reliable for the content or documentation. But what if indeed you are required to send an affidavit? Would that mean because you sign it, you certify somehow that the content is correct? Therefore, would that be binding to the taxpayer, you would say?
That's an interesting, very good question, Terence. The affidavit actually states that the transfer pricing policy has been consistently applied. It is not a statement which says that the transactions has been undertaken at arm's length. And to be honest, between you and I, well, within this room, I don't really give a lot of credibility to the affidavit. because in many cases, the registered auditor is not really a transfer pricing expert. He's just a registered accountant in Saudi Arabia, but for some reason they have got this requirement and there is no threshold to it. So all companies have to provide their disclosure form and the affidavit. But the affidavit is not a guarantee that which says that the transactions have been undertaken at arm's length. Yeah. Any more?
Very quick. So you mentioned that for Qatar, they follow the preferred method approach, which requires that if you don't have a cup, you have to request permission to use something else.
Yeah.
Is there a broader definition of what a cup is in Qatar? Because I feel like this would result in numerous requests by taxpayers.
Yes, there is the definition of the cup, and that's very much in line with the OECD guidelines. So taxpayers are quite clear as to what the cup is involved in Qatar. Yeah.
It just seems like a massive administrative burden on the
Yeah,
government
yeah.
as well as the taxpayers.
Yeah, and I think it is something that they will be reviewing to become more in line with the OECD. And that's the thing about this region, and we're going to see later on Africa, that they implement some regulations and then they revise things every year. So there are constant changes every year. So, and they improve, which is the positive thing, is that they improve on the regulations. But on the flip side, for the taxpayer to constantly have to deal with new stuff every year, it becomes a burden. Yeah.
Thank you. Well, thank you, Rubina. Thank you. She is a partner at Global Tax Service.
And I think Terence has got a question for
sorry.
Cedric.
Let's do it.
Thanks, Edward. I didn't want to interrupt your parts, Rubina. Cedric, thanks a lot again for the presentation. Morocco, you mentioned that the best for you defense or to protect your clients' interests would be to provide benchmarking studies that you would do instead of referring to other type of comparables. But you also said that the taxpayers, obviously, they release financials and tax returns that might or may somehow be a bit distorted or not completely true. So would that, by the same token, pollute the benchmarking study, which would necessarily reflect those mistakes, so-called mistakes in the tax returns?
Well, obviously, you're right, but I think that's not something you should care about, because at the end of the day, if you want to win a case, the only objective is to be able to either negotiate a good amount for your client, which means in the negotiation phase, you would be able to convince the tax inspector and say, okay, look, if you disagree, we will go before the National Tax Committee, and it won't be funny at all for you. That's really the speech you have to. But if you go before the National Tax Committee, it would be quite easy, because people from the jury in the National Tax Committee are quite skilled people. They will understand the case to a certain extent. So the only objective is to be able to say, okay, the taxpayer has no benchmark. I asked for the sources, he refused to communicate. Now, please have a look at my file. I have a benchmark. There are some references in the local doctrine about the OECD principle. I followed the chapter 3 in the building of that benchmark. I have independent company in Morocco, in that sector, and the interquartile range goes from X to Y, and I'm exactly in the middle. Okay, and then see what happened. But if you are able to do so, you probably win the case. Because the National Tax Committee, and we have to recognize that, is quite objective body. Okay, so you really can win in front of that National Committee. Just to give you another anecdote and a previous experience, just one time the tax administration in Morocco gave a benchmark in the tax notification. And in that benchmark, there was the taxpayer. Okay, so we said, well, almost 90% of your comparables are dependent subsidiary of multinational groups. And there is even the taxpayer, us. And he answered, it means I'm 100% targeting the right market. So again, it's navigation in the chaotic environment. Okay.
Thank you, Cedric, Ravina. We will now welcome Antonio Pina. He is the partner at Transfer Pricing Specialist in Greece.
First of all, just if you have not noted, neither Greece nor Spain is in Africa, Middle East, but unfortunately our colleague Borsin from Turkey has not able to. Yes? Okay, better. Our colleague Borsin from Turkey cannot join us. He was injured in the earthquake was last month. So I will try to replace him. And when Ariadna told me to participate in this panel, say, well, what can I talk about? Because you have seen that Cedric and Rubina has explained very well the transfer pricing landscape in both areas. And I will try to talk about intercompany financing in Middle East and Africa. First thought was we were recently working in a case of a Spanish multinational with subsidiaries in Africa and Middle East, and in a project to how to push down the funding from the matrix, the funds that they get from the market to fund the operations in the societies. But well, when I started to elaborate on this, I said, well, the solution is not regional related, could be in any region. And second, I found out this that is a note issued very recently in January by the South African tax authorities about how to apply the arm's length principle to the financial transactions. And basically is copy and paste from Charter 10 of the OECD guidelines. Keep calm, guys. You hear the full explanation about Charter 10 in the Latin conference last year. I will not repeat. But it's interesting because in South Africa, until 2012, they have the traditional think-up ratio rules. That means that the interest exceeding related party borrowing exceeding 3 times the equity of the company would not be tax deductible. In 2012, they repealed this the traditional think-up rule and substituted by the UK approach. That means that both the amount of the loan with related parties and the cost of the loan should be tested with the arm's length principle. This interpretation note translates or clarifies how to apply the arm's length principle based on the guidance, the recent guidance on financial transactions. As I said, they cover both situations. First is how to evaluate that the amount of loan is arm's length. For this, the criteria is a principle stated in the transfer pricing guidance in Chapter 10, but they add some examples how could apply the adjustment in case that the conclusion of the analysis reached that the related party borrowing exceeds the amount of arm's length, how to calculate the non-deductible interest. In the same, the traditional approach when the interest rate agreed in the intercompany loan exceeds the arm's length rate. And also, finally, the secondary adjustment. Since 2015, South Africa has a secondary adjustment legislation. So the amounts that were considered not deductible in excess of both the arm's length debt amount or the arm's length interest rate would also trigger a secondary adjustment. If the recipient of this excess is a company, they would be considered a dividend, and be taxed by dividend tax in South Africa. And if the recipient is an individual, a natural person, it could be considered a donation and subject to the South African donation test. Well, this is in South Africa. What happens with the rest? Because it's usual that this change from the traditional think-up ratio methodologies and substitution by the arm's length principle. Not at all. Make a very brief survey in some jurisdictions, and we found out that generally transfer pricing is included in the legislation at the same time simultaneously with either the traditional think-up ratio rule or the most recent approach of the limitation of interest deduction rules. In fact, all the jurisdiction, because Qatar, there are not specific TP rules on financial transactions, but they, as explained by Rubina, they have included the arm's length principle in the legislation, and they are based on the TP, OECD TP guidelines, included Chapter 10. So probably we can check Qatar also. And as you can see, there are some jurisdictions that include the application of the arm's length principle to both the loan amount and the interest rate. All of them apply to the interest rate. In some countries, also this interest rate is capped by the regulations. This means on a yearly basis, the tax authorities or the central bank regulates the maximum rate for related party loans. So you have the arm's length principle and not a favor, but cap. Traditional think-up ratio also acts as a cap. And what happens when we have these both type of rules, the arm's length principle and the traditional or the new think-up rules? How interact these rules? Well, you should bear in mind that you should comply with both of them. First, with the transfer pricing rules. First step will be to analyze whether the amount of the loan could be arm's length. If it is arm's length, you can pass to the next step, but if it's not arm's length, you should take into account that portion or overall loan should be recharacterized as equity. Second step, testing the Austrian rate. And one is we have passed the transfer pricing rules. When we have the arm's length interest amount, is when we would apply either the think up rule or the limitation of interest. And well, this is all I have to mention about this. But as we mentioned in the seminar last year, the main issues relates to the first test, how to test that the loan amount would be arm's length. For this, we have no clear methodologies, either not in Africa, but in many countries. And probably we will have a challenge for both the tax authorities and for the consultants. Some takes approach by calculating ratios using a traditional benchmarking, but other more sophisticated approaches like Luxembourg using the equity risk. Probably one of the advantages of a PPI network is that we can share our experiences about different approaches in order to get more experience, in order to advise better to our clients about the different positions that I take in the tax authorities regarding this matter that is uncharted territory for all of us. And thank you very much for your attention. And if you have any question.
Thank you, Antonio. Antonio Pina, partner at transfer pricing specialist in Greece. There's any question for Antonio from the audience? Yeah.
Thank you, Antonio. I'll give you a bit of context on the Canadian side, and then I'll ask you the question, and well, to all three panelists. But on the Canadian side, I think it's one of the areas we've seen with regards to audits is reviewing intercompany financing, and the way the CRA has been doing it is they come in and they look at the borrower's credit rating or they proxy it, and then start playing around with finding comparables as to, well, unsecured loans in these jurisdictions, all that stuff. So we've been having a lot of fun with that. But have you seen a lot of that on your end with regards to I'm just wondering if it's something that, I'm sure it's not just in Canada, but
yes,
whether
definitely.
Okay.
Definitely, because in Europe and I think in everywhere, funding is one of the key issues. Interest expense is one of the controversial issues, especially in certain industries, in real estate, in project finances, and it's the point one in tax audit in these industries, and especially when we are in structured finance. Oh, my friend, in structured finance. And they test sometimes the amounts. Last year we have the first experiences in the real estate industry in Spain, in which the tax auditor challenged the amount of the loans based on statistics of the construction industry. And in other cases, they challenge the nature of the loan. For instance, if we have a structure, I have been prepared an expert report for court recently for a very big multinational group in which they were in the typical project finance for wind farms. You have a syndicated loan amounting of around 80% of the total investment. And later on, there was funding by the partners in form of equity. Quality question: the subordinated nature of the loan. What is well? They could also characterize to equity, but in this particular case, they just challenge the subordination clause. That is that in fact was imposed by the banks with the ordinary funding. So, but this is common. Generally, tax authorities have not a very solid and deep finance culture. So for them, it's difficult to explain the economic rationale behind this type of complex structured finance and project finance and so on. And also that sometimes you may think they look at an static position and they don't see the evolution of the loan, because in a project finance or in a real estate project in multi-year period, you may find that at the early stages of the project you have a lot of debt, but the project is profitable enough to serve these loans and also provide enough profit at the end of the project. So probably, or what we used to do is a projection, financial projection, in order to evidence that the debt cover service ratio of the whole project in the long term provides an arm's length position considering the overall project.
Thank you. There's any other question from the audience? Okay. Thank you, Antonio. And for our last presentation, we welcome you again, Rubina Dina. The floor is again yours.
Sorry, guys, I am back. So I've got my GTS Africa cap on now, so I'll whiz you through to Africa. So this is just a bit about GTS Africa. It's a member firm of Global Tax Services, and we provide our services through to all on all the countries colored blue, and our office is based in Mauritius. So what I'm going to be covering today is sort of same format as the Middle East. So giving you an overview of the landscape across Africa. Obviously, it will be very high level because we're covering a region. And then I've picked a few countries which have been quite good at keeping up with developments in transfer pricing regulations internationally. And finally, we're going to have a look at the tax risk and controversy in this region. So when I think of the status of transfer pricing across Africa, one word comes to mind: it's very diverse. And so for the purpose of sort of giving you some idea, I've grouped countries into 3 different brackets. So the first one are countries which have done well with keeping up with developments, the OECD Action Plan. So which means that requirement in the tax code, they have quite a comprehensive transfer pricing regulation. Later on in the next slide, we're going to have a look at some of these countries. The second group are countries which are trying to work out what to do. So they certainly have got the arm's length requirement in their tax code. They do have some transfer pricing regulations in place. They're not comprehensive. The documentation requirements are not really enforced. So in this category, countries such as Angola, Namibia, Democratic Republic of Congo, Botswana, Madagascar, Mali, Malawi, I would tend to group these countries in this category. And finally, countries that do not really have transfer pricing regulations. It might be one of the reasons because they don't have the resources to really understand the transfer pricing, the complexities of international business. So not a lot of countries, so South Sudan, Chad, Niger, and Mauritius. As for Mauritius, I'm not sure. I would say no resources. For some unknown reasons, Mauritius have not yet implemented transfer pricing regulation. It has got the arm's length requirement, though, in the income tax. And actually, yesterday I was reading 2 cases which just came out this week. The Mauritian Revenue Authority does not recognize the DEMPE. And also, there has been another case where a loan has been granted between 2 related parties with no interest, and the Mauritian Revenue Authority does not see any problem with that. So that's the status of transfer pricing in Mauritius. It's great. We shouldn't go there because we won't have a job. So in this first group that we see on the previous slide, so countries which have got comprehensive transfer pricing regulations and have got transfer pricing reference in the tax code. So the likes of Ghana, Nigeria, Uganda, Kenya, Tanzania, Zambia, Zimbabwe, South Africa. So out of these countries, Nigeria and South Africa had transfer pricing regulations quite some years back, and they are probably the most active in this region, followed, I would say, by Kenya and Ghana. Kenya is becoming very active. Kenya and Ghana actually for 2 years in a row, they've revised their transfer pricing regulations. Zambia had a great win with their Mopani mine case, and so they're becoming more confident about their audit process. Zimbabwe a little bit behind, and Tanzania could, in certain cases, be quite proactive. Have I missed any country there, Cedric? Especially in that previous one. Does anything sort of jump to mind as to... Because I know you've done some work in Mali, right?
In fact, in my personal experience, there are countries in which you may have some TP legislation in place, for example, Chad, where you have a TP on your phone to file, but there are clearly countries in which you won't never had a transfer pricing tax auditor challenge, and at least to date. For example, in Algeria, it's a big country. In Algeria, you may have trouble with customs. In the worst case scenario, you can have a challenge on the tax deductibility of some expenses, but you won't ever have any tax audit, transfer pricing audit, I mean, about the tune or something like that. Mali, same case. I had the opportunity to train both the Malian and the administration from Madagascar and Burkina Faso. They don't challenge transfer pricing for the simple reason they estimate they don't know much on the topic.
Yeah. I mean, many of these countries do not have a dedicated transfer pricing department. So on this slide, I've captured some of the aspects of the transfer pricing regime for the countries that we saw on the previous slide. So you would see that all the countries have got TP guidance in the tax code, and they all have transfer pricing regulations. When it comes to documentation requirements, it is Ghana, Kenya, Tanzania, and South Africa, which have got filing requirement. All of the countries in this slide have got it's upon request. And it's South Africa and Tanzania, which have got a threshold which applies. In terms of the transfer pricing return, which needs to be filed with the income tax return. So Ghana, Nigeria, and Zimbabwe have got this requirement. Though I've got South Africa as no there, but within their income tax return, there is quite a detailed disclosure requirement as to related party transactions. And I know that Kenya is working on having a quite involved transfer pricing return, which would need to be filed with the income tax return. So when it comes to country by country reporting, all countries have got this requirement apart from Tanzania and Zimbabwe. Not surprising, many countries do not have safe harbor in Africa. It's only Ghana, and it was from last year that their transfer pricing regulations were revised to include the safe harbor. APA, there's not a lot of APA program happening. So Nigeria, Uganda, and Tanzania have got APAs in their transfer pricing regulations. But for instance, Uganda do not have any APA which have been filed. So there's there's practically little expertise when it comes to APA. And in South Africa, APA is under discussion at the moment. So we expect maybe by sort of end of this year, we'll have the APA in the transfer pricing regulation.
May I add something? About
Sure.
that slide.
I was wondering where that's coming from.
No, just a comment. You know, obviously, that in the local file BEPS format, one of the last requirements is to communicate on some APA eventually signed abroad. I personally think it's quite unfair to ask to communicate on APA signed abroad when you even don't have an APA regulation in your own country. You know? So, in fact, what was interesting in Cameroon, at the very beginning of the year, I think 4th of January, they published the decree on TP regulation, and in the same time, with the finance bill, they transpose an APA program in internal law, which is quite fair and clever, I think. It's not the case, for example, in Ivory Coast, which has with the Finance Act for 2023, TP regulation, local for master file, and no APA program. And if you look at that slide, there are TP regulation in documentation requirements in almost all countries, and in the majority of countries you have no APA, which is quite unfair.
Yes, I think it really comes down to lack of resources. I mean, some countries do not even have a dedicated transfer pricing department. So to have an APA is just not going to be possible for these countries. Another note on this slide, Kenya, though, does not have an APA, but a taxpayer can apply for a private ruling. And Kenya does have a quite large transfer pricing department, the KRA, Kenyan Revenue Authority, I mean. Now, tax risk and controversy in this region. So I've got on top first, it's a rapidly evolving landscape. So what's the challenge about this is that, especially as with, I was just saying earlier, Kenya and Ghana for 2 years in a row have revised the transfer pricing regulations. Now, many subsidiaries, many companies operating across Africa do not have the resources that other companies in other regions might have. Some do not even have a tax department. So the finance department is trying to deal with all the tax requirements. So to have to understand new regulations every year sort of coming up, that can be quite challenging. And sometimes the way that the provisions are written are not very clear, or the requests are just do not make much sense. I mean, one example is last year, Kenya came up with revisions as to parties which come under the scope of transfer pricing. And so transactions with parties, unrelated parties, which are located in low tax or tax rates or jurisdictions which are not cooperative in terms of disclosure of financial information or disclosure of banking information. Transactions with these parties would come under the scope of transfer pricing. Now, I mean, can you imagine a company having to know which party, whether the party that he's dealing with, and it's an unrelated party, whether that party has disclosed, if there is a banking requirement, has disclosed this, it's going to be very challenging. And actually, it's something that when I've spoken to the KRA, the tax inspectors themselves do not know how to apply this new provision. So, and what I hear is that it is someone from the political arena with really great ideas, with the right intentions, who've sort of inserted this provision at the last minute, and then it might be reviewed this year. So there are the sort of things that companies have to deal with in this region. The second one on the right is the simplification approach. Now, that creates a bit of confusion with companies which operate in outside of Africa. So, for example, headquarters or parent companies. So, in terms of the low-value services, yes, there is the recommended, or in the OECD guidance, that there is the simplification approach which can be adopted to ease the burden on companies. But that simplification approach hasn't really been taken up by many countries in Africa. So sometimes companies, headquarters would think that for their low value services that they provide, they can just do a markup of 5%, and that should be okay in the African countries. And there is not a lot of information which is provided as to these services. So these type of transactions do tend to get caught by the tax inspectors. Also, we are seeing more platform-based businesses. So that means that intangibles are becoming increasingly under the focus. So intangible itself is quite tricky, first of all, to identify and to do an analysis of intangible. So that is raising quite a few queries, and the tax inspectors themselves are not really expert in this area. So it can be some quite interesting conversation regarding this. And on the left, a related party definition. So that should read definition. At the moment, it's definition. Sorry about that. So some countries have gone beyond the OECD transfer pricing guidelines in defining the parties who get caught under the scope of transfer pricing. As I was saying earlier, for example, Kenya now have unrelated parties who are based in low tax jurisdiction or tax haven. So it can be quite difficult for entities which operate in the region to identify whether that party is a related party under the related party definition of the transfer pricing. And Ghana has got this requirement as well. And so does Zimbabwe. So quite a few countries have got this unrelated party being caught under transfer pricing scope. Intragroup services. So I think Cedric was mentioning earlier management services. So it is quite an important one. Like I would say probably about 2 years ago, tax inspectors used to accept like invoices and intragroup agreements as proof that services have been provided, but that's no longer the case. They are asking for a lot of information, and these information tend to be quite at granular level. So things like emails, timesheets, they are looking at resumes. So quite a lot of information, and I think I was having this conversation yesterday with someone. We're talking about tax authorities looking at LinkedIn profiles. I think that might be with you, Terence. Yes, LinkedIn profiles, and then matching that to the information which is being provided by the clients. So had to be very careful with this one as well. So that's it from me. Any question?
I will take the advantage of being in the panel to share a gossip of a client of mine about operation in one of the countries that you have mentioned in Namibia. My client is a Spanish company that has a subsidiary. They operate in the fishing. They have a subsidiary that has a ship, personnel, shipping, selling the whole production to the parent company in Spain. Since you mentioned there are not TP documentation regulations, so the client was happy. Nothing to do in Namibia. No care. Was preparing the holidays, and I received the call from the client. We have been received a notification from the Bank of Namibia because they have requested the invoices, the selling invoices, and they test the selling prices with the prices published by the Ministry of Agriculture and Fishing, and they say that they are below those prices. And they ask for an explanation based on the foreign exchange controls regulations. Well, we provide the background data that we use to produce the TP documentation in Spain, and they would manage with the lawyers in Namibia to attend the question from the Bank of Namibia. This was in the summer. We go to the beach, no news, until Christmas. We were preparing the work for the next year, and in a small talking, they say, well, we have problems in Namibia this year because the Bank of Namibia has frozen the bank account because we were unable to explain the differences of the prices with the official prices of the ministry. So this is important that not only thinking in transfer pricing about income tax or customs that we mentioned, Cedric. Yeah. There are other stakeholders in those countries that could be interested in the transfer pricing issues. And you may have problems with the renewal of permits or the foreign exchange control legislation, foreign investment legislation, even in those countries that have not yet implemented transfer pricing administration, because the lack of resources of the tax administration does not imply that they could have resources in the central bank, in the multilateral banks that they told us yesterday, and could be important to consider the clients that even if they have not transfer pricing documentation requirements yet, to be in advance and be sure that the transfer pricing are okay, not to have problems in doing business in those countries.
Yes, indeed, that's a really good point. It's not just about transfer pricing. There are many stakeholders, and there are quite strict foreign exchange controls across many countries. For example, that's the case in South Africa, where invoices have to be reviewed before payments are made. So there are many stakeholders. So I always say to clients where they have got head offices based outside Africa, there is that perception that, it's this country do not really have transfer pricing regulations, which is really well enforced. So we don't want to spend we don't want to spend money on preparing documentation, on doing benchmarking, and then quite, randomly an assessment or a query come through, and the client then get caught by surprise. So I always recommend that documentation is, especially where it's quite a significant operation, that documentation is prepared. Any more questions or remarks? Oh.
Two additional comments from my side. First one, as regard the technical assistance or management fees, because I don't know if it's the same in English speaking countries, but in French speaking countries in Africa, there are almost always a threshold for tax deductibility of the technical assistance and management fees. And so the question is how to deal with that. And my answer would be that as soon as you have a double tax treaty in force, and that DTT is aligned on Article 9 of the OECD Convention, the only thing that should be taken into account is the respect of the arm's length principle. And the tax mechanism shouldn't be worse than that statement. So probably if you have a double tax treaty in force with the other with the country of a related party, that local rules is invalid. That's the first comment. And the second comment is about APA, because I didn't talk about APA in Morocco in my speech, but there is an APA program in Morocco for some years now, and it works quite well, in the sense there are numerous of applicants. But to give you some feedback, I have a file with the APA. The APA team in Morocco is a team of 4 people. And the file is just a TNMM on IT services performed in Morocco by a subsidiary. So it's really a routine activity. And we are discussing with the APA team for about 4 years now. So when I was working in Luxembourg at the beginning of my career, probably that kind of APA would have been signed in the afternoon. And in Morocco, it's 4 years now, it's not signed yet. Probably there is a balance to find between both countries, but still, it's discouraging for taxpayers.
Well, thank you. There is any question from the public? Well, seeing not, thank you very much for our last panelist. It was really interesting. Thank you so much. So this is almost the end of the last session. Before we do the closure of this 2023 annual global conference of Pride Partners International, we would like to invite Adrian J. Romero, who is the CEO of Pride Partners International. in order to give some closing remarks from the conference. Adrian? Yes.
Thank you very much. Great panel. Well, I just want to say thank you to all for coming to the event. Making the effort of leaving your offices, your house, flying here. I'm officially in zombie mode right now. It feels like the conference was more like a boot camp. 2 days nonstop. But I think it's special that so many things could happen in 2 days. I think a lot of people here previously met through Zoom calls or one-on-ones, and right now I think there's a very good bonding between everybody here in the room. So I can say that new not only business relationships are being built, but also friendships. I heard very good positive comments from many people regarding the the event in general, but also the private conversations and efforts that you will be doing together to expand and work together, and some ideas that you already shared with our team on some initiatives for the year. So I think that it's going to be a very good year for the association, the group, and now I think it's our responsibility as a group to continue welcoming the new members that will be joining during the year. So thank you for all that you've done, to all the presenters, preparing their materials, their presentations, coming here and sharing their expertise with the group. Very valuable. Obviously, to our team again, thank you. You didn't see Ariadna and Luceli over there, but they were sleeping, tired as hell. So that's really important that we have a team that's really committed to making the association work and being of service to everybody here. Tonight we will have our last social event. We're gonna be joining I think Luceli at 7 o'clock tonight in the lobby. We're going to leave the building at 7:15. We need to get on the bus. Ariadna will be at our destination, making sure the building doesn't leave us. So we're safe on that side. So just please be on time tonight, 7 o'clock in the lobby. We're gonna have a good time tonight, and then I really hope that everybody has safe travels back home. I know some people are probably staying to enjoy the country for a while or going to other places. So enjoy the rest of your trip. If like in the airplane, if Paris is not your final destination, so have fun. And we hope that we can meet again next year in whatever our next destination will be. We're not sure, but also next week we will be sending you an email with the recording of the entire event. You can see if you can see something or share with your team, and also some pictures, and also the PDF files of all the presentations. So I think that's a wrap. Thank you so much for being here, and we'll see each other later tonight. Thank you.
Well, only one point. We will take the pictures at the backing, right? Oh, or here. Yeah. So please don't go. Right. Let's share the panel also. Thank you very much.
Of course, me too. I sent it to this the afternoon, I think.
I was going through it lots of time, but and then once was still left.
Yeah.
Pero nuestro maestro decía, bueno,
Beautiful, beautiful people.
Yeah, yeah, back.
Well, then I'll be at the back. Okay. Sure. Sure, guys. Keep that. The camera's full.
1, 2, 3, smile.
Yes.
Coma. With the second.
Do we also Captain Spakan?
Please open your eyes. 1, 2, 3.
Look like you mentioned half of the lecture.
Hey, so yesterday I was told I was not inclusive in our little 5 cassette between the lobby, between going and all that. So you guys want to go across the street, grab a pint before meeting back up in the lobby at 7? All right. It's a general invite. And they also have smoothies and other stuff. Huh?
Yeah, we have to be allowed. Next time we'll have to be allowed. Would you like to have a picture with the screen?
Like this? Another one? Thank you.
Here we go. Smile.
Yeah. Acá o acá, no sé, la pata. Bueno,
No, no, es otro.
¿Quieres sacarte solo?
Can you,
Sí, bueno, luego lo puedo editar.
No, it lost the entire meaning. No, 50%. We share a drink, so this is what I'm saying. Yes, that's what I told